Present yourself.
Yeah. Stand over here.
Okay, so welcome back, everybody. Sorry about the little trouble with the lunch. Unfortunately, Bitcoin doesn't fix this. This kind of stuff still happens, and I hope you still enjoy the dinner. So we're a little bit late with the schedule, but it's all going to be good. I'm really happy to have Alex Daskalov here, who's the CEO of Knox, a Bitcoin Montreal-based company that does custody for institutions, insured custody for institutions. So I will let him start right away. Thank you.
Hey, are the slides up or we should? Okay, they're good. How's it going? Yeah, so I'm Alex, co-founder CEO of Knox Custody. We're a Bitcoin custody and key management infrastructure company in Montreal. And today I'd like to talk about a few different topics, but one of them is just the set of properties that you can think about in terms of custody and how different trade-offs come to play. And along the way, I'll explain also what Knox is as a company, what we're up to, and what we're doing in the future. So broadly speaking, the trade-offs that we see in the custody risk spectrum are as grouped as follows: kind of self-sovereignty, simplicity, and security. These aren't necessarily in order, but I'll start by talking largely about self-sovereignty because I think it is one of the most important properties. And as somebody who runs a ostensibly centralized key management system, I think it's especially important for me to speak about this. So we're going to talk about the case against delegating any action to a third party, which is effectively saying the situation in which you as a personal holder, should not use a custodian such as Knox. And we'll come to use that to explain, why Knox actually exists and what it is for. Bitcoin as a network has many important properties, and we'll focus on two of those. One of which is that Bitcoin as a network is permissionless. Anybody can join this network, anybody can interact with it, and it is censorship resistant in the sense that a rule should never be that you, as one particular individual, cannot perform a transaction because somebody deems you to be an undesirable person. And these properties are really critical, and we'll talk about these as we talk about kind of self-custody versus the use of custodians such as Knox and otherwise. There's kind of two broad actions that a peer in the Bitcoin network will take. One of those is that you will engage in consensus formation. So you will declare a set of rules that you believe should be followed by everyone else in the network, and others will do the same. And an emergent property of this is that a valuable network may emerge where you might agree with a set of peers on the rules that should be followed. And then a secondary point is that you will be able to prove ownership of that which you own. So you'll be able to spend UTXOs and prove to the network that this is something you can do. And the really beautiful thing about Bitcoin as a network is that these things are possible without any existing legal structure, right? So if the entirety of the legal system as it came to exist were to disappear, you could still do these things, and you could do them so long as the internet is up and the network exists. And this is something, I suspect I'm preaching to the crowd here, this is something that is very important to the network, and I believe not sufficiently understood or appreciated by a lot of newcomers. So I call on you to appreciate these things, which I know you already do, and to explain these things to the next set of entrants to the network. So on the point of self-sovereignty, the ability to declare your own rules is really critical. So this means that you can run a full node, you can connect to the network, and you can say, these are the rules that I wish to follow. And if you come to consensus with a set of other peers, can produce a valuable network. And the ability to prove ownership for yourself, which is to say, I can sign for a transaction within my own self without delegating to any other party, without relying on any other intermediary. And this, again, ends up being really important. And so this first property is the one where I focus on, which is self-sovereignty. This means run your own full node, control your own keys. And later on, we'll talk about what it means to bring new people into the network such that they're maintaining these things. But I think it's really important that we encourage this kind of behavior. And I started the presentation this way because I will speak for a long time about some other properties exhibited by Knox, the centralized key management system, which necessarily does not allow for self-sovereignty. So I'll say, why Knox? given that I'm somebody that believes that in your own holdings you should maintain self-sovereignty, that's actually one of the most important properties. Why would I want to be running Knox, and why does a system like Knox even need to exist? There's a few reasons for them. I'll focus on two of them. One of them I think to be quite legitimate in the sense that this is why really we run Knox. The other one we see a lot of, and I push back against to some degree, but it's important to understand why people feel this way. The first is that you are not holding Bitcoin for yourself, and I'll give you a few examples. One is perhaps you're a physically settled Bitcoin exchange traded fund. There's reasons why we should be happy that such things exist for the network. It allows a lot of new entrants the ability to come to at least participate in the value ownership of Bitcoin without necessarily being legitimate Bitcoiners, and we can potentially shift them down the line. Or you are a fund that happens to purchase Bitcoin for whatever reason, or in the case I'll focus on for the rest of the presentation, you're a company, you want to maintain, for example, Bitcoin on your balance sheet. Ultimately, that Bitcoin is not owned by any one natural person within that corporation. So it's not the CFOs, it's not the CEOs, it's not belonging to the board, it belongs to the company. And that's a situation in which you might want to say, I want to delegate the management of keys to a custodian such as Knox. But I will maintain that for personal holdings, you should not give up self-sovereignty, even if you can gain a lot of security and simplicity along the way. It's something that we see a lot of. Sometimes people come to us and say, look, Bitcoin allows you to be your own bank. I don't want to be my own bank. I want you to take care of keys for me. We will not turn those people away. In some cases, we will accept those people. But it is important for them to understand that they are giving up a kind of self-sovereignty property, and that they should, in time, revert to actually maintaining their own keys and running their own full nodes. So Knox at a high level, we really provide two broad products. The first is, and you'll see insurance come up again and again, and I'll explain in a moment why that is. The first is insured key management. So you come to us and say, I would like you, Knox, to maintain Bitcoin for me. I want you to deal with everything that comes with the complexity of private key management. And all I want to do is be given an address or a set of addresses to which to deposit, and I want the right to withdraw that Bitcoin if ever the time comes that I want to do that. So that's kind of the first product we offered. The second, and I'll explain why this is important also for insurability reasons down the line, is you can take the system that we run that's deployed today globally, and you can deploy it in your own right. And this is in the case that you're a bank or another custodian, a corporation perhaps, down the line, maybe a nation state or otherwise, you could take a lot of the same infrastructure that we run and operate it in your own right. It's the earliest days for us on that front, but it's something we're quite excited about. So I'll focus for the next moment on kind of what Knox has been especially keen on advancing. And I'll bring up another property of Bitcoin to explain why we're so interested in this point. So Bitcoin is a bearer instrument. This is to say, if somebody ever takes or manages to spend UTXOs that you feel you legitimately own, there is nobody you can turn to for help, right? If somebody spends a UTXO on chain that you feel is yours, it's gone forever. And broadly speaking, we think in terms of two classes of events that can occur, and one of those is loss. So, say you produce a set of private keys, you lose those private keys, no one for the rest of time will be able to spend those UTXOs, including yourself. You have been, effectively rendered an irrevocable loss. And the other event we think about is theft. So somebody steals private keys from you and manages to cause a spend on chain that you did not want. The way these risks sort of transpire in the real world is very dependent on the context in which sort of custody takes place. And it's something that we'll talk about when we look at centralized key management systems such as Knox versus your own holdings. Knox, for example, spends a huge amount of mental energy on preventing theft and producing technologies that reduce the risk of theft. I personally think that personal key holders, in the case that they're self-custodying, which they should be, are very likely over-indexed on theft. And we'll sort of look at some examples down the line, which is to say, I know a whole lot of people who have lost their Bitcoin because they managed to lose their private keys, or they encrypted their mnemonics and failed to decrypt them. And I know exceedingly few, in fact, I would say close to 0 people who have had their Bitcoin legitimately stolen. And we'll kind of cover some of these events and what they look like. Whereas for Knox, loss is more or less, once taken care of, it's taken care of. The amount of things that need to go wrong in the world for Knox to actually lose funds due to private key loss is just ridiculous. But we spend a lot of time thinking about theft. Like, what does it mean for somebody to actually attempt to steal from us, either from the outside or the inside? In the context of delegated key management, so for the rest of the presentation, I'll stick to, you're a company, you chose to put some percentage of your balance sheet into Bitcoin, and you want to hold that Bitcoin, and you don't want to deal with key management, and your board believes that it's not appropriate for you as a company to deal with internal key management, and you delegate that key management, say, to Knox. A well-developed key management system like Knox's is, frankly speaking, exceedingly unlikely to lose Bitcoin, either due to the destruction of keys or a theft event, either external or internal. But as a core belief at Knox is that this event does not come with a non-zero probability. So it's worrying to me that a lot of people start talking about cold storage as if it's this so impossible to steal from thing that nobody will ever take a loss. And one of the things that bothers us as a company is that insurance against these events, we believe, should be at least an option. And it is troubling at the moment. Something like maybe $100 billion, $200 billion worth of Bitcoin is held in centralized custody. And very generally speaking, maybe 1% of that is insured against loss or theft of any kind. And here I have an argument often with centralized key managers. Their point is, well, the likelihood of this event is basically 0. And my argument is, I agree, but if the likelihood of this event is effectively 0, you should be able to buy a cheap insurance policy against that event transpiring. So when we arrived on scene, there's a few things we wanted to do differently than others. Broadly speaking, we wanted to be insured against 3 broad classes of events. One is against the loss of private keys, so some destruction event, hurricanes roil through, et cetera, all of the underlying key material is destroyed. That ought to be a claimable property. We should be insured against external thefts. Somebody from the outside manages to break into our system, steal. That needs to be a claim event. But most critically for us was, how do we, as the key managers, prevent ourselves from stealing? Because if you are a custodian, your job is to be able to sign off on transactions to move funds. So how do you make sure that you are not unnecessarily, causing transactions that should not exist? And so when we started, we said we want to insure against those properties. And broadly speaking, we were seen as a little bit crazy because that's more or less everything that could go wrong in a custodial system. The policies when we came into the business were quite narrow. And one of the things that we were especially adamant about is that those 3 properties that I just claimed need to be claimable through the entire key life cycle. So if you want to say, I am insured against our people stealing from, your wallet, it had better be the case that you're insured across the entire private key life cycle. So it can't be that you're insured at the time of signing, but not at the time of generation, or at the time of generation, but not at the time of transport of keys. It needs to be that from the time that the entropy was first generated, the keys are first generated, through till signing, through till the eventual departure of the account. Every single event from A to Z is insured. And this was, frankly speaking, quite a difficult undertaking. There's a lot of technology we built to make sure that we could actually do these things. And I'll show you briefly what that looks like, and then we'll sort of use that as a springboard into talking about custody for institutions and companies and otherwise for yourselves. So we built a geographically distributed key management system. One of the things we really looked at, especially because we wanted these insurance properties across the key life cycle, is to say, let's study and understand and think through the entire private key life cycle and attempt to separate lower and higher frequency event. So for example, in the lifetime of a key set, you might generate those keys a single time, and maybe those keys will live then for the next 100 or 200 years signing for transactions. You'll note that basically the time at which a collusion event can occur for key generation is relatively low. For key signing, it's maybe for the next 200 years. And so one of the things we did was to say, could we make it such that we could seriously hamper the abilities of people to cause theft events in the higher frequency events, sort of for the lifetime of the account, while seriously reducing the risk of collusion, say at the time when lower frequency events are built. So here we have the Nosq system, and this is for kind of product one that I described, as it exists today. It is spread across 5 cities, 3 countries, 2 continents. And that same system per product 2 that I mentioned is something that is deployable by others. And we'll look at sort of what we spoke about, the generation of private keys, the storage of private keys, and the use of those keys to sign across the key lifecycle and what it looks like for Knox today. And then we'll get back into kind of personal custody. So Knox makes heavy use of on-chain multi-signature support. We generate keys across 4 distinct cities. And a great thing about multisig in this way is that there is 0 information outside of the public key information that needs to be shared between these zones. And so you can think of it as almost 4 completely distinct systems that can come to exist. And so you really need a large number of people to come together to actually collude in order to cause an insider theft event. Besides that, we get into some pretty extreme redundant key storage. So a single account comes to be stored across 16 distinct vaults across the world. And then the most important part for us in terms of minimizing internal theft by way of collusion is to say, how can we hamper the ability of our agents from stealing from our accounts in the most common event, which is signing. And so we've implemented something that we call a signature swap transaction. Our signing centers are made such that even somebody who is physically resident at the building should not be capable of coercing machinery in that building to produce a signature for an account unless a customer has requested that signature be signed. And what that looks like from the customer's perspective is they actually hold on to a set of private keys that are not on-chain private keys, but unless we could forge signatures from their own set of private keys, we cannot, at the signing level, cause a theft to occur. And this is for us a really nice trade-off, which is to say we make it near impossible for us at the signing location to cause a theft to occur, with the caveat that if the customer lost everything that we gave them, we would need to reconstitute that account. But a nice thing of the system is that we can actually reconstitute that account. It just comes with great expense and difficulty because we'd have to reach into the globally distributed layer to do this. I'm going to stop soon there in terms of what Knox is and what we built. But to give you a flavor of the upcoming future, today we've implemented a 3 or 4 multi-signature system that exists in 5 cities. One of the things we're doing to expand kind of horizontally scale the insurance capacity that we have is to take that same system and to say, what's to stop us from building it a second time, a third time, a fourth time? And in many cases, should it be us building and deploying that system and operating it, or should we partner with and rely on a third party who can actually take the very same infrastructure that we built and have them operate that? There's a lot of things we can speak about in this space, a lot of interesting things that you can get into once you deploy this thing. As a neat example, you don't need to think of these deployments as separate necessarily. You might say, there's 20 plus, signature generating facilities across the world. Maybe pick a random selection of those and you start getting a kind of combinatorial explosion of the number of distinct MFN key bearer sets that you can get. Not something we've yet implemented, but something that quite excites us. Now, I'll step away from kind of centralized key management to get back into what I also like to think about and speak about, which is what should people do with their personal holdings, which again, I maintain you should very likely not use a system like Knox's because you should be self-sovereign. And to see in Canada in particular some of the regulatory changes and some of the trends we're seeing. So recently, the CSA, which is broadly speaking Canada's version of the SEC, said, of course, Bitcoin is not a security. Nobody could possibly claim otherwise. It's obviously not a security. But if you as a company exist and you do something like, say, allow somebody to purchase Bitcoin and then allow that person to withdraw that Bitcoin at a later date, What you are selling is not Bitcoin. What you are selling is an investment contract that allows you to reclaim that Bitcoin. An investment contract is a derivative, is a security. Now suddenly you are in our crosshairs. And there's some great outcomes that could come from this, and there's some troubling outcomes. So the good outcome is that maybe this will push people to self-sovereign models. Great place to call out bull Bitcoin and verify. This is the way, if you will. People should rely on services that are inherently non-custodial, where the purchase of Bitcoin requires you to say, where would I like to get the Bitcoin once I bought it? And this is a great way to do things. The troubling outcome for me is that still a lot of people are hesitant to get into self-custody, and we'll speak in a second about how to fix that situation. The thing that really worries me about is, call it the PayPal model. So PayPal comes out and says people can buy Bitcoin on PayPal. Great. But can people withdraw Bitcoin from PayPal? And the answer is, at least at the immediate moment, and they've promised otherwise, the answer is no. You can buy Bitcoin, supposedly, or the value of Bitcoin, and you can maybe sell that value and then pull out dollars, but you cannot purchase Bitcoin and then withdraw that Bitcoin into an address that you control. And one of the things I really worry about, and we're starting to see examples of this elsewhere, say in Canada with Wealthsimple with similar promises, a worry is that a lot of newcomers believe that Bitcoin is something that is purchased as an investment, and that they see no difference between holding it in something like PayPal and then later being able to sell it for a profit and actually maintain it a self-sovereign way. And I think it's really important for all of us to help our friends understand, one, the beauty of a permissionless network, like what it actually means for something like this to exist, such that you can interact with it where it sits completely outside the legal system, and so there's no intermediary, whether legal corporation or otherwise, that stands in your way. So you're not dependent on a PayPal, you're not dependent on even a Knox, you're not dependent on anything to actually transact with it. And that having X amount of Bitcoin in dollar terms is not what matters. The self-sovereignty property is really, really critical. And here, and I think I'm running out of time, so I won't be able to get too far into this, but I like to think a lot about what it means to help your friends get into Bitcoin such that they are maintaining self-sovereignty. And there's a lot of things, especially as running a key management system, I've been forced to think about. One of those is thinking for yourself and for your friends about loss versus theft. Going back to what I said, I think loss in terms of losing keys, for example, for Knox is a near non-issue. It's very unlikely that that ever happens. But that is, frankly speaking, the critical risk for a lot of newcomers who are holding Bitcoin in their own right. Whereas theft is a property that I think is fun to think about in a sense. A lot of people are like, oh, somebody's going to come after me and steal all my Bitcoin. It's something that Knox has to spend a lot of time thinking about, but I think that personal holders are very likely over-indexing on that. And I think that a lot of us helping early Bitcoiners in this realm perhaps overthink that as well, especially if we have relatively sophisticated self-custody setups that we maybe should not be recommending to others. So going a little bit against the grain, I would say, for example, don't do things like push multi-signature on new Bitcoiners too early. I'll give you two examples. Suppose somebody were to come to you, suppose two people were to come to you, and let's play this out over 5 years. One of those people downloads, Blue Wallet, buys $1 million worth of Bitcoin, or happens to have $1 million worth of Bitcoin, pushes it into that address, keeps the mnemonic and puts it in a safety deposit box, maybe handwritten on a note, clear texted, versus another person who comes to you and they produce a 2 of 3 multisig, and they have 2 cold cards, and then they encrypt the mnemonic for each of those key sets, and then they put them in different locations the world over. Sort of think forward 5 years, what's the likelihood that each of those people have taken a loss, and what is the actual event that would have caused a loss? Now, in the first event, you might say, oh, somebody found out that this person had a lot of Bitcoin, and they found out that they're running a particular Android version. They went and got a 0-day and managed to break into their phone, steal their private keys, and cause a theft. Versus the second case where this person managed to forget one of their mnemonics or forget how it was encrypted or something went down. Either of these events are possible, but I really think that if you think about this, the likelihood of a loss between these two people, the first person is more likely to actually be able to keep their Bitcoin if they were relative newcomers. This isn't to say anything against multi-signature or the use of more advanced methods of custody. People can grow into those things, but I think that a lot of the times I've seen early entrants into Bitcoin get fearful based on relatively expert people telling them you should do this thing and this thing and this thing, and they start saying this whole thing is so complicated, I'm not going to self-custody at all, and I'm going to go and buy Bitcoin on PayPal and never actually own it. And I think that's injurious to the community, and we should be very careful about over-complexifying these things for newcomers. And this gets back to kind of the security trade-offs. I started with self-sovereignty, where I almost think of it as a binary. Either you have self-sovereignty or you don't. And in the case of, say, you're a company and you're going to delegate key management, you don't have self-sovereignty, and that's okay because of the context in which you exist. If you're a personal Bitcoin holder, you should maintain self-sovereignty. But the important thing about security and simplicity is that this isn't like you give up one to get more of the other. Sometimes you can actually go and give up both. So I would argue that in many cases, people will increase the complexity of their self-holding setup while, in a sense, decreasing the security because the likelihood of a loss event actually increases. And then kind of on the point of slow walking, I think that everyone should make newcomers aware of what it means to be self-sovereign. And this means both maintaining your own keys so that you can sign off on transactions, but it also means that you are part of the consensus formation, that you are capable of declaring the rules that you wish to follow. And that point is really important, but might be a lot harder for somebody to grasp. They might say, what difference does it make? I agree with this set of rules. Other people are maintaining this rule set. I just want to transact with it. And I will say, at the beginning, that's okay. If you can find somebody and get them into a situation in which they're self-custodying such that they're actually maintaining their own private keys, great. Let them do that for a while, maybe even increase the relative security of their setups. Just be careful to boil the frog and not push them too quickly into that. And then down the line, you can get them into doing something like running a full node and everything else. So, we're here for a long time. You don't need to. My argument really comes down to if you attempt to push somebody too hard, too fast, you will break them and they will just refuse to enter deeper into this. Just do it kind of a step by step, step at a time, and always educating and having them understand the risks to which they're exposed. So yeah, that about does it for kind of these points. Happy to do any kind of Q&A. Otherwise, I guess we'll be hitting up dinner relatively soon.
We still have 15 minutes, so I don't know at what point you were at the presentation, or you want to take questions?
No, I figured I'd do a 30 minutes of presentation. Yeah, happy to answer any questions. Have maybe spoken at you for long enough.
Okay, so a little round of applause for Alex.
Yeah.
I was interested in knowing because I heard like in the States there's a guy who specializes in taking people's holdings that they have like in, I think their IRA is the equivalent of like a TFSA over here, and that you can actually, instead of holding GBTC in your IRA, you could have like Bitcoin like in cold storage through this legal setup. Would that be like beyond the scope of what you guys are interested in doing? And if is there a possibility of doing something similar here in Canada, where you don't want to have QBTC or whatever, and just hold real Bitcoin in cold storage, because maybe you feel like down the road there's going to be a better, higher premium on cold storage Bitcoin than what they have in a centralized exchange?
Yeah, so it's a good question. I think that a lot of that comes down to the legal frameworks that allow you to maintain, a Roth IRA, which I think is the equivalent to the TFSA here, while maintaining your own keys. I believe we're a bit away from that Canada-wise, and it does. This is like if you are capable of maintaining your own keys, I would certainly say if you want to get the Roth IRA exposure, you should do that as well. But again, this just comes down to somebody who's actually capable of maintaining their own keys. So it's almost a legal layer above whether you're maintaining your own keys or delegating those to somebody else. But yeah, I'd actually like to learn more about the extent to which we can do that in Canada. I'd be a good candidate for that. I want to maintain my own keys. If I want, TFSA coverage or whatever, then, I'd prefer to do that. At the same time, maybe I'm not a great candidate because I'm not buying these things to sell them anytime soon. I like to think I'll outlive the CRA, and so a lot of it's moot. But yeah, we'll see.
Could you give us maybe like a rough idea of what is the fee structure to use the custody service at Knox? And the question I have is, when a client calls and wants to move Bitcoins, how much time it takes to make it happen through the process?
Sure, yeah, good question. So we offer broadly two services, which is fully insured, dedicated insurance holdings. And in this case, for the amount of insurance you wish for us to purchase on your behalf, we make sure that every dollar of coverage purchased is bought for you and you alone. This is something that we maintain quite differently from other custodians, which is we do not share limits. And one of the things that we see a lot of people doing is to turn to each customer and say, you're insured for 10 million, you're insured for 10 million, you're insured for 10 million, when all they've done is purchase a single $10 million policy. The sort of Bitcoiner way to explain this is they're double spending insurance policies, which I think is wholly inappropriate. And so we charge 100 basis points per annum for relatively small accounts, kind of sub 50 million for that service. And then otherwise we charge 35 basis points for basic key management where there is no insurance purchased. And I will say some people will elect to say, I want to save money, I don't need the insurance. The fact that you guys are insured for these events gives me all the confidence in the world I need to know that the thing is not going to happen. I don't want to pay extra in order for you to buy the insurance. In terms of kind of turnaround time, a lot of these safety features we've implemented in the system actually increases the speed at which we can turn transactions around. But there's a whole lot of extra checks that we also go through. So the promised time is 24 hours from the first time that you lob a transaction at us correctly authorized to the time that you can expect to see it in the mempool. In reality, it will happen faster than that, on the order of kind of 4 to 6 hours. But the SLA that we promised our customers is 24 hours.
So there's no per transaction fee, like the 35 basis point plus insurance, is there maximum? I know it's cold storage and that's supposed to move the Bitcoins around a lot, but there's no per transaction fee.
Well, we'll apply per transaction fee of sort of 10 to 15 basis points or $150 greater than two, depending on some account types. But yeah, this is very much, for most of our customers, I'm putting it in there to expect to not move it or not to swash it around too much. And yeah, typically transactions are both large but also very small against the total value held per account.
So do you guys at Knox do the service of, let's say I'm a company and I want to start taking payments in Bitcoin, but I don't know much about Bitcoin, and does not Knox intervene to help to onboard companies and then help that company do custody with you guys if they want? Because let's say that would be the purpose of contacting you guys. So my question is, do you guys help new companies that don't know much about Bitcoin but would like to be into it?
Yeah, I mean, we get approached by different companies for different reasons. We have not onboarded a customer, say, where they become customers of ours for the purpose of them accepting Bitcoin. In a sense, it's something that we'd be interested in doing, but I think is maybe a little bit outside of our forte. They might be better off speaking to people who understand a lot about BTC Pay Server or whatever else, and then helping integrate those points. Certainly, when somebody approaches us, either we'll help them directly and onboard them if we see that there's a good fit, or point them in the right direction such that they can learn more.
You can go to verify.
Yeah, that's right. Maybe that's the way to go. Send to verify is the first secondary step.
I'm just curious as to how are these keys physically held? Meaning, I guess all the keys on the multisigs are held on cold storage wallets. Where are these cold storage wallets held, and what kind of security do you guys have for this this structure?
Yeah, so that's a good question. I will say, one, you didn't ask this question, but it's sort of relevant to the next answer. Every account at Knox is distinct from every other at the sort of entropy level. So we'll generate new randomness for every single account. And every account in the system that I'm displaying here is a 3 or 4 multi-signature set, which means that there are 4 distinct key sets generated for that account. And then I can use that to explain how these are actually stored. Once an account comes to exist, the orange boxes you see here are what we call archival vaults. They're basically backups. They are generated effectively one time, if you want to think about it that way, in the life of the account. And they exist in 16 vaults spread across the world. That's where they sit at the, like, we can always recover from that setup. Where they are used, and this is where we separate the sort of low frequency events from the high frequency events, those keys are known within an HSM, 3 HSMs in particular, that are the ones actually used to make transactions in the usual case. But that HSM employs a very important property, which is that it says, in order for me to sign with the key that I know, you need to prove that you have the right to ask me to sign. And there is a distinct private key that is used to actually sign that request for withdrawal. And those private keys are held only by the customer, but those are not on-chain private keys. And what this means then is that people who are capable of physically touching these machines, the green ones, cannot cause it to produce a transaction that it would not have wanted to produce unless they can forge the customer's own signature. While it is the case that if the customer were to lose all of their private keys, because they're not on-chain private keys, the green boxes that you can see can be, at some expense, reconstituted using the red-orange set that you otherwise see. This is kind of the basis of the system. So it comes down to, once the account is generated, it's quite safe. It's close to as safe as a shared signature model. But if the customer loses everything, say you're holding $50, $100, $200 million worth of Bitcoin in this system, and they say, I done goofed, everything that you gave me is gone, we say, not great, but we can recover for you. It just means that we have to now go to each of the archival sites in order to reconstitute their account. We've not seen this event yet, luckily, and we charge something on the order of $50,000 for that recovery. But if you lose $50 million or $100 million worth of Bitcoin and you're told that you can recover it for $50K, you'll be quite pleased.
So just like crazy scenario, you have like a super volcano, Yellowstone explodes and all of North America gets destroyed. You still have that other location there where everything can be recovered, like we're in Scandinavian vaults.
Yeah, I can tell you, so we're capable of suffering the loss of the entirety of the United States, or the entirety of Canada, or the entirety of the UK, or the entirety of the United States and the UK, and still be capable of moving funds. If we suffer the entirety of Canada and one of the United States or the UK, things will be lost. But that is an insured event, if you so choose to purchase that. And I've been in conversations with insurers where we're walking through these scenarios, and at some point we're all looking at each other and saying, you guys realize what we're talking about here, right? This is a cataclysmic event. But this is why I said it's a non-zero probability, right? It is possible, in theory, for all of Canada and the UK to disappear overnight for whatever reason.
Can you talk about how you were able to onboard an insurance company? Because I assume you had to sit with them and go through the whole system, like with some actuary or something.
Yeah, so the insurance, I mean, given our focus on insurance, it's a great question because we really came to them and said the insurance policies that you've written to this date are not good enough for us. We want these properties. Here's how the system works. It took close to 1 year with a lot of time by me personally spending with a lot of different insurance carriers to help them understand how the things work. Once they understood at a theoretical level, they effectively said, if what you say is true and the system actually maintains these properties, then I will allow for this widening of the scope of coverage. But I am out of my technical element when it comes to assessing whether, basically, if you guys are full of shit or not. And so they went and hired a set of third-party kind of technical assessment firms and said, have these guys explain to you what they've built, and you attempt to break it and see if you can. And a lot of that interaction with those firms was we would give them effectively this system as it exists in the world without a lot of the physical security, and they would attempt to cause the theft or loss events that we claimed were very unlikely. And only after a slew of those assessments were conducted and the insurance carriers were told by those firms that they believe the system to be capable of maintaining the properties that we claimed, was the insurance policy sort of bound. So this was close to a year of back and forth with insurance carriers. And I will say also that insurance policies of this sort, much like any piece of software, is never done. So we're always trying to speak to them to further increase the scope of coverage, everything that we want to see, be assured that all of these claim events are in fact possible, and otherwise sort of continue to iterate on the policy. So there's kind of no end to this. Yep.
Merci. Hi, you were speaking earlier about not only being insured for your custody offering, if you will, but also having people be able to run your systems by themselves and be insurable. So do they have to go to the same insurer as you do, or is this type of contract being better understood gradually by the industry? Are they able to go to another insurer and say, here, look at what AIG or whatever is insuring for them, blah, blah, blah?
For the most part, it should be this similar set of carriers. One of the reasons that we can claim this property, that we can get other people running our infrastructure and get insured, is that the insurance carriers that we've onboarded are comfortable with these systems. The way insurance in this world exists at the moment also is that there's really only so many insurance carriers that will cover these things. Another question perhaps that we get often is, so who's the insurer? And the thing is, each of these systems is capable of, at the moment, around $700 million of capacity. There is not an carrier in the world that will take all of that risk directly. So you actually have a whole lot of different carriers that will take different parts. They'll say, I'll take 30% of loss from 150 million to 200 million. And someone else will say, I'll take 100% of loss between 550 and 600, et cetera. There are, in terms of the set of carriers in the world, for example, who would take this risk, one of the unfortunate caveats that we had to deal with when we were binding these policies is that a lot of the carriers looked at the scope of coverage that we were demanding and said, you guys and the carriers who are agreeing to this are out of your minds. That is too wide a scope of coverage. We're not going to take this. And so we'd lost capacity due to an attempt to expand that scope of coverage. But it's not like, we will help those entities gain the insurance coverage that they need, but there's a set of people in the world that would ever think about taking these risks. We've excluded some of them because they won't accept the scope of coverage. And for the most part, you want as many carriers who are willing to accept that scope of coverage as possible. It's not like, I want to go with Geico versus AIG versus whoever else. It's like there's a lot of them. In order to expand the scope, in order to expand the capacity, a lot more are needed. And really, that is kind of our next mission. Our first mission was the scope of coverage is not wide enough. And our second mission, this is where kind of this thing comes in, is 700 million is not enough for what the world needs. Like, we need to get to 10, 20, 50, 100, 200 billion dollars worth of capacity. And we have a method by which we believe we can do that. But for us here, it's kind of brick by brick, continue expanding that insurance world, which to the earlier point about the insurance policy is never done. Until capacity is trillions of dollars, which is going to take forever, we're not really done with our insurance vision. Yep.
What's your target customers? Are they institutions or more individual investors?
Yeah.
Institutions usually they use, let's say, Coinbase. Coinbase is excluding as well, right? Why they choose another solution for custody?
Yeah, I'll give you sort of broad categories, the first three of which would use something like what you see here. And then the other one is kind of the second product. Broadly speaking, a Bitcoin business that is, as a side effect of its operations produces, a lot of Bitcoin in its own custody. So this might be, for example, a Bitcoin exchange that allows you to withdraw Bitcoin after purchase. What a lot of them have found is, even though I allow my customers to withdraw, a bunch of them just don't. And I just keep getting more and more Bitcoin in my coffers. I can't sleep at night. I don't want to deal with this thing. I'm trying to tell them to withdraw and they won't do it. Here it is. Another one is like family offices, which is perhaps an example I could have shown where it's like, it's a family, it has its wealth distributed across a number of different things. Who should be holding the keys for that? Should a family office be self-sovereign? You could argue in one way or another. Oftentimes these family offices are sort of managed by a family office wealth manager, and it doesn't really make sense for that one person to be holding on to private keys for their Bitcoin. The third, and this is sort of relevant to also the fourth, is proper institutions and funds and things of the sort. Knox has taken the route of saying we want to partner with existing brands and institutional entities that have the relevant regulatory capabilities in various jurisdictions without us doing it directly. So for example, we're partnering with entities that can call themselves either because they're banks or trust companies as qualified custodians in Canada or elsewhere. We don't think it's our place nor our specialty to engage that. Whereas they don't know how to do good private key management systems, which is why we've developed a system that is deployable and operable by others. Which brings me then to the fourth customer, which is those that wish to take the infrastructure that we have and deploy it for themselves. And so this is your existing custodians, perhaps Coinbase is an example, perhaps banks that want to get into this business but want to maintain private keys but don't have the internal chops to do this. It can include nation states. We're starting to see a lot of interest, for example, and this is fairly early days, but we're starting to think, what does it mean for a nation state to hold Bitcoin, right? Is it going to just use an American custodian? Is it going to use some non-American custodian? Or is it going to be willing to bring up its own internal key management infrastructure so it can actually be self-sovereign in a sense and hold for its own right, but it can't be like, the president is sitting with a cold card in his drawer. Or whatever, the central bank. It can't be a set of people just holding private keys in their drawers. So yeah, hopefully that answers it. Probably yeah, three of the first category, and then the third kind of melds into the second category, and yeah. Yeah, so I mean, we're funded by various venture capital firms, and one institutional investor that I need their permission every time I mention them, but probably easily found. But yeah. And then otherwise, we're increasingly partnering with, and a lot of people are surprised when they see who has actually invested in Knox, because they'll note that those investors have investments in other things that look like custodians. And once they realize how broad our insurance vision is, they start realizing, oh, actually, Knox is really complementary to existing and future custodians. Frankly speaking, the reason we built a custodian as step one was to originate the risk, because the insurance industry will not let you approach them and say, I want to improve the policies unless you're actually buying the policy. And so we needed to originate a large amount of theft and loss risk in order to be able to even play in that field.
Have you guys looked into, or is this something that might interest you guys for like people running Bitcoin Lightning nodes, and you need
Yeah.
to, yeah.
Yeah, so I mean, it's not something that we've directly, besides some Skunkworks projects, been directly developing, but it is something that we wonder about. So one of the points here is, the digital signature lies at the heart of a lot of systems. You might use it to do, on-chain movements, but you also might interact with Lightning. You might also want to be a federated node within Liquid. There's a lot of other things that you might want to be able to do with a system like this. Early days, I'd like to spend some more time thinking about that, looking at that. But ultimately, the layers that come to exist above the base layer are of interest to us. And we believe that if we're providing infrastructure for the base layer, it's very likely that we should be providing infrastructure for the layers atop it.
Like what would the setup look a little bit like this? Would you guys have like some kind of like warehouse where everything is secure, like you could run your servers, or would it be like a different implementation?
I mean, if you're using the model, say, that we're using for custody, a lot of it comes down to if there's any situation in which you need to effectively delegate signing because you're afraid of maintaining a private key, then you could use the infrastructure we have today. I think it's kind of early days. I think a lot of the products in the future, it's hard to say the extent to which they look like some of the first iterations of our base custody product versus other pieces, but a lot of the same properties really come up, which is there's something dangerous to hold in a sense that this theft or loss could lead to a value loss, and you want to delegate that use because you're a corporation or otherwise you don't think you should be responsible for maintaining that sensitive information on behalf of your own customers.
We're actually ready for the next presentation. No? Okay, last question.
Yeah, so I think in 2021 we've seen the start of a lot of institutional investing, like MicroStrategy and Tesla. I guess since Knox are targeting a lot of institutional investors, I'd just like to know if you've seen an uptick in institutional demand, and if you're seeing this demand accelerating in 2021 as the year goes.
Yeah, I mean, if you want, so certainly I think the notion of corporations bringing Bitcoin on their balance sheet was something that we all knew would eventually transpire. I don't know if you want to call that the kind of the institutional set. I'm a little bit hesitant to say this time the institutions are coming because I feel like this has happened cycle after cycle. We're like, oh, this time it's like the institutional cycle. It does feel that way, both looking from the outside and then also from the inside, as if there's a lot more institutional interest today than there was previously. And then I'll use that also to say I actually think that there's more, in a sense, latent institutional interest. For example, a lot of institutions that would want to get into this, except that they see too many risks, one of which might be underlying theft or loss. And so I think that increasing, for example, the insurance capacity available in the space is important in order to bring into the fray those who are on the sidelines looking in saying, I would if only, and that a lot of those which we will see have not yet even appeared as prospects.
Yeah, so we'll be ready for the next presentation. Okay, so another round of applause for
Okay.
I think we should be proud to have such an amazing company here in Montreal. It's crazy. It's the future. So I think there was a lot of questions. I think you have a lot more, so you'll be hanging around.
Yeah,
right?
for sure.
And you'll be there at the dinner? Or?
I'll be at the dinner, yeah.
Yeah, so you have also the possibility of discussing with Alec directly. Thank you again. Yeah. So be ready to jump to our next presentation. So that was like a really last minute change, and we're happy to have the guests we're having. It's going to be Adam from Upstream, one of the co-founder, if I'm not mistaken. So he's already on the call. We'll be joining him.
Yeah, thanks for having me.
Hello, Adam.
Can you hear me? Can you see me?
Yeah, we see you and we hear you. I'm really sorry about the trouble, but and thank you again. It was such last minute, and it's great you want to talk about what you're doing at Upstream, and people are excited to hear everything about that here in the room. So yeah, you can go on. I don't know if you have a presentation or.
Yeah, I don't have a like a PowerPoint presentation, but certainly I would love to share about Upstream. I work for a company called Upstream Data, and we are founded in Alberta, main headquartered in Calgary, and we're a company, we primarily build portable modular data centers for oil and gas companies to leverage in order to mine Bitcoin. Right. So the premise of our business operation is the fact that in the oil and gas industry and upstream oil and gas production, there is an seemingly immeasurable amount of energy that gets wasted and burned in the form of flare gas. And so the primary reason behind all of this wasted gas oftentimes is just geographical location and economics. The location of the well is such that the cost to build a pipeline to sell gas is incredibly high, and the ROI is something nobody's going to participate in. No producer is going to participate in. And so instead of, waste money building a pipeline, they just burn the gas so that they can still produce crude oil, which is profitable and economic to them. What we do is we help oil and gas producers who are looking to leverage Bitcoin and capture that gas, right? One, there's an environmental mitigation factor, right? The emissions from burning methane gas are not great, right? It's better to combust it, but still CH4 methane oftentimes is vented beyond the flare, and CH4 emissions are certainly an impact on air quality. So beyond just the environmental impact, there's an economic sustainability because you're able to with the Bitcoin network, you're effectively able to sell electricity anywhere you have an internet connection today. And that, in our opinion, is Bitcoin's real killer app, right? It's the really disruptive and incredible aspect of the Bitcoin network is it's an autonomous energy consumption market, right? It's as long as you have an internet connection, you can sell electricity and you don't have to deal with a counterparty. There's nobody really on the other side of that trade. You're rewarded for your electricity from something that was programmed, a decade ago. And so all day, every day, what I do is I'm on the phone with oil and gas producers talking with them about their oil and gas wells. And we figure out, hey, what's an appropriate amount of power to generate with how much gas you're wasting? And from that, what's an appropriate building to build for you? And how many Bitcoin miners are you able to power? This is what that looks like, right? This is the amount of money that you could potentially be making by mining Bitcoin instead of just burning this gas. And oil and gas producers are coming around. We were founded in 2017. So it's been, 4 or 5 years building in this space. I'd say the last 9 months have been absolutely insane. It's, everyone seems to be coming around. Oil and gas producers are waking up to this technology. The price of Bitcoin obviously helps, right? I think the price of Bitcoin is a powerful manipulator of opinion, but beyond that, it's becoming legitimized, and this technology has been proven. The concept has been proven. And so anywhere in the world where energy is being wasted, not just in the oil field, but in any capacity, whether it's wind or solar or hydroelectric, we believe Bitcoin mining is going to be integrated because those who are producing that and operating that operation are incentivized to integrate this secondary market where they can sell electricity, where they can sell energy. And so I think we're in the very top of the first inning of one of the most exciting disruptions to upstream oil and gas. And I'm helping, Upstream Data build for it. So, as an American, I'm the only American employee of Upstream Data. I'm really proud to work for this company. I think the founder, Steve Barber, is a really driven guy and ultimately has a very clear vision of how Bitcoin integrates into upstream oil and gas production. And I think we're going to see really big things in the next 10 years when it comes to mobile deployments of Bitcoin mines throughout North America. And we're going to see it on behalf of the oil and gas companies. And so, I'm not sure if it's something that people are relatively familiar with, considering this isn't the first year of doing this, but, I think is really just starting to kind of get serious and pick up. And so, I was happy to be asked to come and share that with you, and I'd love to answer any questions. I'm sure people have a ton of them. So,
perfect. I just want to say first, thank you, Adam, for that little introduction. You have by far the coolest background ever of all the speakers. I see all the details.
Yeah.
I see even the banana. How do you call this? The little orange. Yeah, the orange bag
fanny
from
pack.
Miami.
Yeah, the fanny pack. Yeah.
So really, really amazing background. That's for sure. So I can start with a question. So you're actually working from the States, or you also joined here? You're working from Canada right now.
No, I'm in the States currently. That's primarily who I'm dealing with, is the the U.S. oil and gas operators that are interested in this process and in our product. That being said, I think as a company, I think we're about half and half in terms of our deployments. I think we have about 120, 130 Bitcoin mines deployed up to date. And I'd say about half are in US, half in Canada. We're about split even now. Initially it was predominantly Canada, and the vent gas that's all over, but we've bled a lot more into the US, certainly in the last 12 months.
Has the China ban had any effect on your business, or was how was that affecting your
well, it
and
was
everything?
It was awesome. It was a gift, right? It was when a whole bunch of competition just packs up and leaves. All you do is help them carry their suitcase out the door. I think it was a really interesting anomaly, something maybe people anticipated for geopolitical or those kinds of reasons, but certainly me personally as a Bitcoin miner, I didn't build into any of my revenue models 40% of my competition walking away one day. So it was a gift in terms of anybody who was mining Bitcoin in that moment, all of a sudden was a lot more profitable and a lot happier about their investment. And beyond that, it makes the economics, when you're going from wasted gas to Bitcoin to US dollars, right? For a lot of the customers I'm working with, it makes that investment look a lot more attractive, right? These guys are often, the oil and gas producers are often comfortable with building pipelines that have, 3, 4, 5-year returns on ROI, and Bitcoin mining is looking like something a lot more attractive than that. Certainly after Bitcoin, or after China kicked out all the Bitcoin miners. Beyond that, hardware has been crazy. The volatility in hardware prices is unlike anything I've ever seen in any other industry. It's similar to, it's almost like it's a black market good is what I feel like I'm dealing in, right? Like the prices change every 12 hours with the Bitcoin price, and supplies are they vanish. It's really nascent right now. I think there's a lot of maturity that needs to take place, a lot of maturation, at least on the hardware side of the industry, and significant amount of investment dollars need to really come in the form of microelectronic fabrication facilities, right? So like serious, significant investments need to come into this space in order for it to really grow to where it needs to be right now, right? Where the demand is pushing it.
Great. We have a really involved audience. I'm sure there's questions. Is there any? Yeah, okay, let's start.
Hey, well, I guess my question is kind of twofold. First, I wanted to ask you if you mine anything other than Bitcoin, if you're looking at the different cryptocurrency that you're mining. And the second part of my question was, well, more of a commendation. Like, I think it's absolutely beautiful that you guys are recycling energy that way. It shows that I guess, well, it's a very important part of the energy sector that we're using, like all of it, not wasting anything. So.
Yeah, no, I appreciate that, and I agree with you. I think anytime you're able to innovate a way to mitigate waste in an economically sustainable fashion, everybody ought to celebrate that. That's something everybody should get excited about. and I think it's a good thing. To your question, in regards to mining anything other than Bitcoin, we don't. As a company, we don't build for anything other than Bitcoin. That being said, our hash huts, our Bitcoin mines could be, you could install other ASICs or other GPUs and other setups in there, but we build primarily for Bitcoin because there's a considerable risk factor here that often those who are maybe pretty deep into the Bitcoin space or really involved in the cryptocurrency world, maybe they don't consider from the perspective of the oil and gas producers. And at the end of the day, if you think about taking 6 or 7 figures of hardware risk, right, buying computers to mine a network, it's really difficult to justify that risk when there's the possibility that the monetary schedule or the rewards that are going to be given from that network could be changed, right? There's one thing about Bitcoin that we know, it's immutable, right? Certainly its monetary supply schedule, utterly immutable. I mean, the community absolutely freaks out if you try to increase the block size, right? Which has nothing to do with the supply or anything like that. But just increasing the block size, the community said absolutely not, and it was shut down. I think that one aspect of Bitcoin, that reliability, that, listen, I'm investing for the decade, right? And if a group of devs can get together and change the mining rewards on whatever network that we're mining and completely blow up our investment, like that's not a risk we can even tolerate. So the nice thing about Bitcoin is, even though it may seem like a risky industry or a risky thing to do, it's the least risky of them all, right? In regards, from their perspective, from the perspective of these oil and gas producers, right? And so I think ultimately, when it comes down to computational density and what innovations are going to be pushed in the future on the hardware side, I think SHA-256 is going to be what the majority of investment dollars go toward, because I think that's where the majority of the rewards are going to be, is on the Bitcoin network. So I think that's kind of a combination of our thesis, our combination of our view on that.
Okay. We have another question.
Adam, what are other energy sources are you guys specifically looking at that are perhaps unknown at the moment, or that people do not think of immediately? Like we've seen with El Salvador and volcanoes are now pretty hyped up. What's your take on that?
Yeah, that's a great question. I'm really glad you asked that. So one thing I think that many people don't know about is ethanol, right? There are some industrial processes, and one industrial process in particular that's growing at an incredible rate, where there's a waste from this process that's very energy dense with ethanol, right? And the process I'm talking about is CBD extraction. And so, with the legalization of marijuana as well as CBD products all throughout North America, there are these companies that are, extracting CBD and THC from the hemp plant. And in that process, one of their waste byproducts is pretty much ethanol with plant matter, with cannabis or hemp pulp. And what they have to do with that right now, because you got to imagine, this is like about as energy dense as the gasoline you put in your car. What they have to do with this waste now is they bring it to this specialized bay, this area where they spread it out and lay it out, and they let the ethanol evaporate off of it over some period of time. And then once all the ethanol is evaporated out, they can take it and truck it over to feed farm animals, because there's just this plant matter left. But it's a costly process, and it's time consuming, a pain in the butt, and it's really dangerous, right? When they have to be very specialized when they transport this stuff, because the slightest spark and it's a bomb. And so they're looking at, hey, how could we instead extract out the energy dense aspect of this waste, the ethanol, and generate electricity with it, because our business is growing at 400%, every year, and we're buying more and more land to grow more and more, hemp, to extract more and more. So we're going to have more and more waste. We need to solve this problem. The power that they have the potential to generate based upon just the energy density and the volume that they have, I mean, it's insane. It's absolutely crazy. And so that would be one of them. Biogas is another. I'm talking to a lot of guys that they use methane digesters, right? So whether they're on hog farms, hog lagoons, or dairy farms, anything with cattle, these digesters are often in very remote areas because nobody wants to live next to the place that smells really bad, right? And so even though they're generating a ton of power, they don't really have a grid to sell electricity to, right? And that's again, back to Bitcoin's killer app. Bitcoin can come and rescue that energy. And so that's somebody that I'm talking to. Even wind and solar, right? I've talked to a few solar operators on varying scales, and it's just because typically they have excess production, right? They're producing more than is being demanded or at various times, right? And so they're just looking to increase their efficiency from peak to trough demand. And instead of varying their load, they can vary, how many Bitcoin miners they're powering up, right? So while the grid's demanding a lot, they shut all their Bitcoin miners down, and then when the grid doesn't demand anything, they push all the electricity to the mines. And so everywhere from the wellhead, the hydroelectric dam, all the way to the transmission line in your local town, to the grid provider in wherever you live, it probably makes sense to drop a Bitcoin mine all along the way, because there's loss and inefficiencies all throughout, where if you dropped in this little mobile market, all of a sudden your economic investment looks better. And so it's gonna be pervasive through the energy stack.
Another question coming.
That was a great question, though. I just want to say, and by the way, there's probably 50 other energy sources that I'm not even thinking of that people are tinkering with right now, right? That's the cool thing about Bitcoin, is it makes people go and seek out these things. So.
Hey there. As you know here, hello? Yeah. So, yeah, as you know, here in the province of Quebec, we're very strong with hydroelectricity. And since the China mining ban, a lot of people have been talking about the fact that basically the amount of energy that is generated by hydroelectricity in Quebec could power the whole Bitcoin network. So I just wanted to know what were your thoughts on this?
Well, I'll say this. I think the point is when China kicked out all these Bitcoin miners, which was a significant percentage of the total network, and an incredible amount of power. We're talking about gigawatts of continuous power generation. There's absolutely miners searching all over the world for a place to put these, right? For a home to put these miners. And I think that anywhere there's hydroelectric is a really good home, right? I think that Bitcoin miners provide a great value to whoever that hydroelectric provider is, right? Because they give that a Bitcoin miner is effectively, right, an electricity purchaser of last resort, right? When nobody else wants to buy the energy, a Bitcoin miner will show up and say, I'll buy it, right? And that's exactly what a Bitcoin miner is. And so if you think about it from the perspective of somebody that's generating electricity and trying to sell it to the grid or something, it's great to have a Bitcoin miner come in, because you can guarantee, hey, no matter what the conditions are out there in the world with the grid that we're supplying, we know we can shove at least this much electricity to this person over here who will demand it at this price. So bottom line, we're able to, generate this revenue, no matter what. And that can change the, if you look at like a 10 or 15 year economic play or an investment, the ability to compound and re-leverage, I mean, that can change the entire health of a project, of a business. And so, certainly I think intermittent power generation, solar and wind, they're looking at Bitcoin mining because it really helps them, but it also helps everyone else that generates power. So yes, I think that Quebec could be a massive, Bitcoin mining hub in the world, just as Alberta could be because of the amount of energy resources there, or Texas here in the United States, or Venezuela, right? Anywhere that there's an energy-rich nation, a nation rich in energy resources, they're likely to be amongst the first Bitcoin mining nations, right?
Yeah, just another question. Bitcoin being probably the most peaceful way to fight off government abuse and I guess war in general, I'm just wondering what's the fascination for you with guns?
Well, it's the same tool, right? It's, I mean, I'm not know if I'm fascinated, but you know, it's a great equalizer. Bitcoin is an incredible equalizer, much like a gun. You know, Bitcoin is something that protects every individual from their central bank, and a gun is a tool that protects every individual from tyranny of their own government. And so, in the same way, I look at the tools as very similar. Bitcoin's cooler. Certainly, I would say Bitcoin's a more clever tool, considering the fact that it's a non-violent way in which to take power away from those who have abused it. It's just really, it's an amazing thing, right? It's just a matter of opting out, right? You can obsolete those who are doing harm to the world, and their harm will cease to be done. And so, you know, I don't know. It's an interesting thing that you asked, because, or that you mentioned, just the fact that the parallel between guns and Bitcoin is, I mean, they're hand in hand, right? It's a matter of individual sovereignty. I think a dollar, and that's the whole seigniorage aspect, right? Is that some people when they get a dollar, the value of that dollar is greater than by the time other people get it, right? Because they're closer to the money printer, they're closer to the central bank. And Bitcoin is a great equalizer where everyone has to play by the same rules. It doesn't matter how important, how powerful, how popular you are. Your Bitcoin is the same. It's just as hard for you to get. It's just you're treated the exact same. And so, yeah, great equalizer, right? I think that's a good point.
Thanks, Adam, for that. Just a point I'd like to bring on what has just been discussed. It's interesting. You've been talking about electricity in Quebec and you know, having guns. I'd like to point out that in Quebec, electricity is a nationalized resource. So gas and hydro both belong to the state. And there has been a moratorium on mining in the province that has been imposed by the electrical regime here. So do we want to claim that back? Yes, of course, I think it's important. So it's, I don't know, it's kind of like a parallel between the fact that you've been talking that we need to maintain our sovereignty over our electricity as well, not over just our property. And, you know, mining Bitcoin through the resources that are around us is crucial, and it's intrinsic to that.
Yeah, I think a point there is that from the perspective of oil and gas producers, not just in Canada and the United States as well, is any energy provider, I think, has been squeezed, right? They've been, certainly on the oil and gas side, right? They've been kind of kicked in the teeth, and their production has been mitigated while imports get increased. It's like, why is Canada importing any oil at all? I mean, Canada has enough oil to generate sovereign power for way beyond my lifetime. You ought not to import anything in terms of oil and natural gas. It's bizarre to me. But here we are, right? It's the same, and the same story happens in the United States. And so I think what the oil and gas producers are seeing is that they're not being really well represented, and the regulators are more their enemy than anything. So oil and gas producers, they could always just begin, exporting their energy to the Bitcoin network, right? Nobody can stop them, right? I think that's one of the most amazing things about Bitcoin mining is, I mean, think about it today. You could be a 16-year-old kid. You don't have to pick up the phone. You don't have to talk to anybody. You don't have to sign anything. Nobody needs to know your name. And you could sell millions of dollars of electricity per day. Nobody could stop you. You don't have to ask anybody's permission. You just gotta configure a whole bunch of computers, right? You just gotta find a power source to fire them up. And that's the same for everybody, right? That's the same for international regimes. You think about the way in which it'll impact international relations, much like what I'm talking about. Countries that are sanctioned, countries like Venezuela, Iran. Well, what happens when they wake up and realize, oh, well, instead of, producing crude oil or natural gas and then having to deal with the United States in order to sell that crude oil, and they limit how much we can sell and they sanction us, we could just export all our energy and get Bitcoin in return just by generating power right here in country. And then we could take that Bitcoin and we can go settle trade with our allied partners around the world in the global marketplace. And we never entered the US dollar. I mean, the US can't sanction that. I mean, if you never touch the dollar, you can't be sanctioned, right? So they can, nation states that are energy rich can completely circumvent these sanctions that have been placed on them, right? And of course, the United States is aware of this, and of course, they've tried to shut down mining pools, and they can play whack-a-mole and try to make it difficult for them as much as possible. But ultimately, they cannot stop it, and it's going to disrupt things, right? And nation states are waking up to this. I think that's what you see with El Salvador is the same kind of concept. They went, holy crap, we can export our energy because there's this for the first time in history, a secondary energy consumption market, right? All throughout history, the only place you could sell energy, whether it be, kerosene or electricity or whatever, was to the populace, right? Was to a grid or to an individual that was going to consume it. Now we have an autonomous, counterparty-less way to sell energy. We have to rethink everything when it comes to how we generate power, how we, distribute power. All of it needs to be rethought because we need to do it with the consideration of, hey, we have a secondary market, right? So when we build, we need to keep the secondary market in mind. So the disruption has only just begun, and I think we're going to see it on a grand scale. For Quebec to kick out all their Bitcoin miners, they're as foolish as China. But much like with China, I sit there and say thank you, because as a Bitcoin miner, you just made my competition, delayed the inevitable competition that's coming. Thank you. But I think it's foolish. I think that they'll regret it and it'll be damning. People will go elsewhere, right? They could attract a ton of economic pull, but they've rejected it. Foolish.
Great. I have a question for you, Adam. How do you, maybe you have read the text of Francis Pouliot, Cry Harder, basically responding to the energy, the Bitcoin is bad for the environment FUD. So obviously you're more on the corporate side, so you have to keep a face and more give some arguments. So on which side of that response you side, and what is your opinion? What do you say to
I'm right.
people?
I'm hand in hand with Francis on that one. I cry harder because the fact of the matter is Bitcoin's impact on the environment is an incredible net positive, right? And then, for example, I wrote an article about this when Tesla came out and said that they were no longer going to be accepting Bitcoin for, payment for cars because of the carbon footprint of a Bitcoin transaction, right? They're going to hold billions of dollars of it, but they're not going to accept it as transaction. That was the fine line that they drew for some reason. And I wrote an article in response to that. My response is that, well, one, if you look at the carbon, the CO2 emissions output, right, which they just calculated from the hash rate, that's a flawed story. Because look at what we're doing at Upstream Data, right? We take much, and often the case in Canada, we go to where there's a vent gas source, where on an oil and gas well, there's literally just a stream of CH4 methane being blasted into the air. And methane is 60 times more impactful on air quality than carbon dioxide is. And so we're talking about 60 times worse as a greenhouse gas, quote unquote. Well, when you come in and mine Bitcoin with that, you consume 100% of that CH4 that's being vented into the air, and you internally combust it, which is better than externally combusting it with a flare. You internally combust 100% of it, and your emissions are CO2 and water, right? And so you're taking methane and you're turning it into carbon dioxide and water vapor, which is the same thing coming out of my mouth as I speak to you right now. And everyone in their right mind would say, oh, well, that's an environmental benefit, right? But people get together and they say, oh, well, but that's still this much carbon, so it's terrible. And I sit there, no, Bitcoin is a solution to a lot of environmental nonsense. It's not the problem. And for the most part, one thing that I think needs to be, always pushed harder in this conversation is the fact that most Bitcoin mining, it seeps into the energy stack and it finds all the energy that was already all the electricity that was already being generated just wasn't being consumed. Because that's the most economic energy, and that's where the Bitcoin miner is going to be rewarded the most, right? It's the reason that guys like myself back in 2018 were on the phone with Upstream Data, having them build me a data center so that I could go out into the oil field and mine Bitcoin with somebody's liability, somebody's waste. So no, I did absolutely stand in protest of the statement that Bitcoin is bad for the environment. I think Bitcoin's impact on the environment ought to be celebrated, and it's a really good thing. Energy consumption isn't immoral, right? Consuming electricity isn't inherently a bad thing or destructive. So I just combat that notion, and I don't think that's our viewpoint at all. As we build out Bitcoin mines for oil and gas producers to help them mitigate their waste.
Yeah, you're right. It's hard to explain that to, I don't know, what socialists or communists, like consuming energy is bad.
Well,
I don't understand. Like, okay, well, you know
yeah,
the
I know,
frustrations.
and I do. I know the frustration, and I think part of this frustration, part of the dilemma here is the fact that you can't really meme this, right? When it comes to how Bitcoin impacts energy production, the environment, electrical, it's not something you can just put in a single meme and bundle into a 5-second message, because it's just a little deeper than that. It's a little more nuanced. You have to go a little bit deeper and talk about, exactly how energy is even produced or how electricity is even produced to explain why this isn't a bad thing. And that's, again, this is an educational problem. This isn't a Bitcoin problem. This is people don't understand how electricity ends up in their house problem. And if they understood that, they would see, wow, Bitcoin's ingenious. This is an amazing invention.
All right. Any more questions? Yeah, let's go.
Hey Adam, it's really cool what you guys are doing, and I wanted to ask you, the engine that you guys are using to consume this methane. Is it something that you guys have adapted, or it's something that's available on the market? And how efficient is this compared to diesel or other fuels? Not that it really matters, because I mean it's wasted gas that you're getting for practically for free, right? And if someone's interested, would this make sense for someone who's been in Bitcoin for a while? And he's kind of a techie guy, and he wants to maybe set up one of these mobile, I don't know, a container that he could just truck around to some of these places. What would be the cost of it to construct something like this?
Well, let me say, so when it comes to the engines, first of all, our huts can be electrified by anything, right? So the data centers that we build, the portable Bitcoin mines we build, can be electrified by anything. We primarily build for oil and gas because we're really an oil and gas company. The founder's a petroleum engineer. That was really, just where we saw the most opportunity as well, the lowest hanging fruit. And on the engine side, typically it's reciprocating engines, right? So we're talking about, pistons. On the smallest scale, it's a Chevy engine, right? On a 50 kilowatt, the smallest Bitcoin mine that we build, which is really, only 15 MCF per day of gas or something. It's literally a V8, 5.7 liter Chevy V8 engine that's been remanned for vaporized natural gas. And then we can go all the way up to, 500, 1 megawatt, massive reciprocating engines that are the size of a mobile home almost, and that just sits next to the Bitcoin mine and electrifies it. And so it's all a matter of what's appropriate based upon how much gas they've got. Then beyond that, right, when it comes to kind of the investment aspect of this, or the marrying of it, I think there's a lot of Bitcoiners right now, and I talk to guys often that are going out and looking for oil and gas producers who have stranded waste gas, and they're looking to broker a deal, right? They're like, hey, maybe you buy the engine, I'll go buy the Bitcoin computers and the data center, and we'll do a power purchase agreement. I'll help you consume your gas, solve your problem, give you some, those are, absolutely, the world is our oyster and opportunity is endless out there. The amount of gas that gets wasted every day just in North America could power the Bitcoin network 6-7 times over. Okay, we're talking about 2.5 billion cubic feet of natural gas gets burned every day just in the United States, right? I mean, that's 8-9 gigawatts of continuous power generation. It's insane. So really, this is gonna kind of take over, and it's up for anybody to come and invest, right?
Adam, do you have a few anecdotal instances of well, I was gonna say fail, but some entrepreneurs that have not had any success or haven't found a way to be successful that have come to Upstream Data and that you guys have reoriented towards mining and so yeah, do you have any examples of people that you helped that way?
Do you mean like anybody that, you know, ended up deploying a Bitcoin mine and it, you know, they were like, nah, this isn't good?
No, I mean, yeah, so I meant that someone that had infrastructure or that wanted to deploy some kind of mining that not related to Bitcoin, but you guys have directed toward or guided towards Bitcoin mining that they had just not thought about that was possible with what they had?
Oh, absolutely, yeah. I mean, a lot of the oil and gas producers that I'm talking to, they're calling me very skeptical. Like they're very skeptical of this. You know, as much as this has been relatively, you know, we've proven concept here, right? You could say certainly our customers that since 2018 look like geniuses today with the decisions they've made to mine Bitcoin, but there's still a high degree of skepticism. The petroleum, you know, upstream petroleum, upstream oil and gas is still a very tech phobic, I could call it, kind of an industry at least. You know, they're very slow to change, and they're not. None of them like to be the first guy through the wall, right? None of them want to be the experiment, and so I think they're kind of slowly creeping and seeing that, you know, a lot of them are waking up and seeing their competitors do this, and so they know they have to look into it, so they're calling us. But really, by the, you know, at the end of the day, what I'm educating them and what I'm teaching them about is, you know, hey, we have a new technology now that allows you to sell energy anywhere via an internet connection. You probably, being a company that produces an incredible amount of energy, you probably at least should take a serious look at this technology and maybe consider implementing it, you know, at least to some degree and explore it to better understand it, and at least get some data and see if it was beneficial to your operation. And you know, for most of these oil and gas producers, that's not too big of a leap at this point. Back in 2018, none of them were going to buy a Bitcoin miner. They just weren't. But today, yeah, they're coming around. The ones that are more risk averse, I think what they do is they go out and kind of like the previous question is they go out and they find somebody to kind of do a joint venture and share the risk with. Sometimes at Upstream Data, we've shared risk with producers and done that at our own company, right? We're also mining Bitcoin on gas as well as a company. But more recently, oil and gas producers have been more comfortable taking the risk. So we build them the infrastructure, they become the Bitcoin miners. You know, we teach them and they're off and running.
Great. Thanks a lot, Adam. Anybody else have a question they'd like to add? No? Do the data centers come with their own node?
Their own node, no. But they come with an LTE modem package, right? So you have like, you know, wireless remote capabilities to monitor it all. Oh, and one thing I guess I could show you guys. Here's a little model of one of our Bitcoin mines that we build. So we had this is a Bitcoin node case actually that's printed to the exact design of our hash huts, our Bitcoin mines. So our hash huts are just like this, and they end up just getting deeper. So we have this is like an 8x4 foot, and then it can be all the way to 40 feet and house, you know, 650 Antminer S9s or 250 of the new stuff. So cool stuff, guys. This is a lot of fun. Thanks so much for having me.
Yeah, it was really nice. So, okay, no problem. Thank you for joining us. Somebody tweeted that just with your energy, we could power half of the Bitcoin network. So,
I love it.
Great tweet.
That's great.
Thank you very much. And I know it was really last minute, so it's really great you could join us. And I hope we can do this again another time.
Absolutely, yeah. No, hopefully I'll be there in person. So. Thanks, guys.
Thank you. See you.
Appreciate it. Take care.
Thank you. Perfect. Okay, great. So we have maybe like 10 minutes of a break. The next presentation will be at 3:45 with Francis Pouliot. So if you want to go like to the bathroom, something quick, we will be back really soon. Quoi? Je pense. Ah, non, non, je sais, je sais. C'est pour ça j'ai fait une pause. Là.
Oui, absolument. Parce que qu'est-ce qu'il parlait, les flares, dans toutes les raffineries, dans tous les...
Bon. Ben, c'est quoi, pourquoi tu te poses ça?
Ben, il me semble.
Ok, moi je vais fumer. Moi. Je vais fumer. Bon.
Ok. Ben, quoi, ma question fait aucun sens.
Mais je comprends pas pourquoi tu me demandes ça. T'as-tu demandé ça à lui? Ah.
Passez s'il vous plaît les coordonnées du monsieur là, qui vient de parler, Adam.
Oui, oui, oui. Vous pouvez le trouver sur Twitter très facilement.
On n'a pas c'est-à-dire le nom de la compagnie ou quelque chose.
Oui, c'est Upstream.
Upstream.
Ouais, ouais. Upstream Data.
Upstream Data.
Ouais.
Donc, eux, ils construisent des mining
Portables qui s'installent près des centrales de gaz. Parce que l'extraction de gaz, ouais, c'est intéressant. Hein. Ouais,
c'est une idée géniale.
ouais, absolument.
Parce que c'est vrai, le méthane,
Ouais.
c'est 6 fois plus.
Ouais. Okay, back to the live stream and the last presentation of the day of the 4th day of the Bitcoin summer. So we'll be joining Francis Pouliot, the CEO of Bull Bitcoin again. He has an amazing presentation about Bitcoin scarcity, which might look like a real simple concept, but it's not that simple. So we'll be joining Francis right now. Hello, Francis. Are you hear me? So maybe while we wait for him, how many coins there is in 21 million, exactly. How many you have? Do you have enough?
How many sats in one Bitcoin?
Sorry?
How many sats in one Bitcoin?
Does anybody know?
100 million. Correct.
Oh. What's up, Francis? How are you doing? We don't hear you, though.
Hey guys, can you hear me?
Yeah, now it's everything's good.
Awesome.
Perfect. So I will let you go on with the presentation.
Great. Can I share my screen? I don't know how that.
Yeah.
Do you know how I would?
There should be something. Yeah, share screen.
It says host disable attendee screen sharing.
Try again now.
It works. Perfect.
Perfect. All right. Enjoy, guys.
There we go. Okay. So I don't know if you guys like see me or only the PowerPoint. Don't need the PowerPoint that much. It's just give some kind of visual background. So thanks again, everyone, for joining. Today I'm going to talk about scarcity, which I conceive to be Bitcoin's fundamental value proposition. And we're just going to basically dissect the emergence of Bitcoin scarcity. So there's two main things that I would like the audience to leave this presentation with. And if those two things are not clear, please at the end, like take down some notes on my presentation and please ask me some questions, because I'm really going to try to guide the logic for you to be able to understand those two things as being true, which is that Bitcoin scarcity is emergent. It cannot be designed, it cannot be engineered, and it cannot be reproduced. As such, it's unique. So before we talk about money and some of the economics behind the value of money, so a lot of people, I mean, that's one of the questions that a lot of people ask when talking about Bitcoin, like, where does the value come from? What's behind Bitcoin that gives it value? Is it backed by something? Is it backed by, people think that the US dollar is backed by the US military and that's what gives it value. That's what keeps the price of it up. And gold is backed by history, or gold is backed by the fact that it's pretty and can be used for rings and for all sorts of things. And people find it visually appealing. And that's somehow what gives gold the value. And here we're talking about commodities that are, or things that are to be used as money. And I think that we can define the value of money generally as being backed by the expected purchasing power of its holders at some point in the future. Or in other words, when you hold something and you value it as money, you ascribe value to it because you believe that in the future you will be able to spend it and exchange it for a certain amount of goods or services, and you find that to be acceptable. Think about why you as an individual will accept like $50 piece of paper for an hour of your labor. It is, of course, because with that piece of paper, you can get, I don't know, a nice meal at the restaurant with your girlfriend, or probably not anymore because of inflation, but you used to be able to do that with 50 bucks. And that's an acceptable trade for you. You are willing to trade an hour of your time for the ability to have a nice dinner out with your restaurants. So why do people, so there's two things here, right? So first of all, when you're thinking about the purchasing power of a good in the future, well, usually you want that purchasing power to be as high or higher than it is today, right? So why do you value Bitcoin as money? It's because in the future, you think that it will be able to buy you more or equivalent amount of goods that it does for you today. And you will be able to exercise this purchasing power. Huge addition to this, right? That means that you will be able to actually spend it. So it's not just that your Bitcoin is going to be worth, like right now, it's worth 50K, 50 grand or something. In the future is going to be worth 250 grand. So you're going to be able to buy 5 times more things, but you're also going to be able to be actually able to spend it, right? As money. It's not just like having gold in a vault somewhere that can be seized in the future. So if you have no faith that you will actually be able to spend it, even though it's worth more, then what's the point of it being worth more? So the value of money is determined by people's expectations of the future. And that is based on two things. Well, first of all, are people going to accept it? Right? Am I going to be able to, is it going to be liquid? Is it going to be something that I can actually use in the future? Is it going to be useful for me? And is the quantity of it going to stay stable or higher? Meaning, is the government or is another entity or will some event create so much more of these monetary units that my purchasing power in the future declines? And a lot of people are rational in making those decisions. These decisions are made at a very higher level. They're made kind of like, they emerge kind of like unconsciously through society. There's not a lot of people that will have an intellectual discussion with themselves or with their friends about what types of money they should be using. It will just become some natural thing. There's a quote, I think from Pierre Rochard, or over the years I kind of modified it, but people will accept Bitcoin because they need to eat. Because the guy who's selling the meat accepts Bitcoin, because the guy who's selling the cows accepts Bitcoin, because the guy who sells the lands to buy the cow accepts Bitcoin, and the people who work on the farm, they only want Bitcoin, and that's how it's going to happen. And all of these people are going to be accepting Bitcoin because they believe that they will have expected their future purchasing power is expected to go up. And before we switch topics, actually, just kind of a side note on this. If you think about it a lot, you might ask yourself then, okay, so why is Bitcoin not a pyramid scheme? Right? So if the value of money, the value of Bitcoin is predicated upon the fact that people believe that more people will buy Bitcoin. Think about it, like Bitcoin is scarce, okay? Let's just go right to the chase now. Like assuming Bitcoin is scarce, people that buy Bitcoin believe the price is gonna go up because other people will buy into it, and other people will buy into it because other people will buy into it because other people will buy into it. And that sounds a lot like the definition of a pyramid scheme. But the difference between people's expectation of future purchasing power, right, the price growing, and a pyramid scheme is that in Bitcoin, you're supposed to buy Bitcoin not because you want to sell it at a higher price in the future, but because it is cheaper for your current self to acquire more Bitcoin than it is for your future self. It is cheaper for your current self to acquire more Bitcoin than your future self for the same amount of time. That's really important, right? So, I mean, I haven't been like on a wage salary for a while since I'm an entrepreneur, but assuming that my last wage, my last salary was 50 grand a year, right? So let's say that, with taxes and all that crap, like 25 grand a year remains, and the price of Bitcoin is $500, with 1 year of work, I can acquire 50 Bitcoins, okay? And in the future, with 50 Bitcoins, it would take like 10,000 years of work to acquire 50 Bitcoins. So I've given myself 10,000 years worth of work as a luxury, right? So when you buy Bitcoin earlier versus later, what you're actually doing is you're valuing your time. It's more risky. So you're essentially buying yourself more time in the future. You're not going to be selling Bitcoins because what are you going to sell them for in the future? There's not going to be any fiat. You're going to be spending them, obviously. You're going to be spending them on stuff, on houses, on land, on luxuries or whatever, on food. So you really have to think about purchasing power and not just price, because if you think about Bitcoin's price, you're relating it to US dollars, euros, or whatever. And if those disappear, then the concept of the Bitcoin price is kind of like irrelevant. So just a side note, have you ever seen someone buy Dogecoin because they're like, oh, I really need to buy Dogecoin now because in the future, I'm only going to be able to buy stake with Dogecoin because all the retailers are going to reject all other forms of money? No. Have you ever seen someone buy Ethereum because they're like, oh, in the future, I'm really going to need some complicated smart contracts to live, and it's cheaper to buy Ethereum today than it is in the future. So I'm going to buy Ethereum now so that I can execute my smart contracts in the future. No, nobody buys Ethereum today because they want to execute more smart contracts in the future. They buy it because some other guy is going to buy it off of them, and they're going to be able to sell the Ethereum for more amount of money. Huge difference between altcoins and Bitcoin in that respect, at least in the culture. Whereas in Bitcoin, you have people for sure that are buying Bitcoin and going to sell them for fiat in the future. That obviously exists. But you do have some people who are buying Bitcoin today and that will never sell because they intend to spend it. In Ethereum, you absolutely do not have that at all. Anybody that says that he's buying Ethereum today to execute a smart contract in the future is trying to sell you Ethereum. That's it. Okay, so forms of scarcity. Well, before Bitcoin, there was other forms of scarcity, which is decentralized digital scarcity. Bitcoin is decentralized digital scarcity, but before Bitcoin, there was natural scarcity, right? So the forces of the universe, the laws of the universe, make it so that some compounds, some atoms merge into gold. Gold emerged naturally from the laws of the universe, and under certain characteristics, under certain contexts, which are incredibly difficult to reproduce. So you can create gold in a laboratory, or theoretically you can kind of like attempt to it. I'm sure one day we'll be able to do it. But it is insanely difficult to do. So there is what restricts the amount of gold in the economy. What prevents people from creating more gold is that there's only one way to, issue gold currently. It's to dig it out, and it's very difficult. And you can't really use, well, you can use technology to dig out more gold, but it's very, very difficult to use technology to create gold. So there's gold that has a natural proof of work element to it, which is at some point, if you want gold, you need to work to get it. So there's a natural rate of limitation of the issuance of money. And that's why cultures all across the world have spontaneously emerged to a gold kind of standard. You'll have cultures that have never ever had any exchange whatsoever, at least not that we know of, or not that are significant enough to have had some like civilization shattering impact, that just coincidentally just chose gold, right? And it's not that they chose gold. So nobody chooses kind of like what money you're going to use. Is that all the other monies that were not as scarce as gold just getting devalued over time. And right now, I'm not doing justice to Steve Dean Demus's book, The Bitcoin Standard, which talks all about this. But just to say that before digital scarcity, we had natural scarcity. And after natural scarcity, we developed a concept called political scarcity, which is if your money is issued politically, like fiat dollars, the word fiat itself means a decree, right? To like a law, right? So government money, fiat money, paper money that we know of today is money that is created by law. Interestingly, in French, fiat, whereas fiat in English is used for calling it decree, in French it's to the Latin root fiducia, which is faith. So it's money which is based on decree and faith in the government that issues a decree, obviously. And so in this kind of monetary paradigm, the scarcity of the money, which is again required for people to have faith that their purchasing power is going to increase in the future, right? So the scarcity must exist, right? In gold, it's natural. In fiat, it's political, meaning that the people trust that the government will not print too much of it. Gold, you trust that the laws of physics will not change, and you're trusting that there won't be some kind of alchemical process which can create gold at large scale, which are two very good assumptions, very sound and logical and rational assumptions to have. In fiat, you're trusting that the politicians will not create too much of it. And why are you trusting that? Well, it's not just because you're stupid. There's been a lot of brainwashing, and not a lot of people are just even aware of the fact that the value of the money they hold is predicated upon the fact that some unknown bureaucrat is going to resist the temptation to print more money. Because, I mean, what makes it so that all of your life savings don't disappear? It is the self-restraint of a bureaucrat and of the politicians not to give themselves and their friends money at the expense of your savings. And I mean, today in 2021, if you still believe that the government will restrict themselves for your benefit, then you're stupid. There's no other way to put it. Or you're misinformed. Realistically, you're probably misinformed. I don't want to, disparage people that aren't spending their time, or they're unmotivated, right? Completely, because this information is out there. You should be able to go see it. But if you really believe that the politicians will be able to restrict themselves, clearly you haven't read anything about history. So these are the two forms to achieve scarcity. And fiat currency is a form of digital scarcity because dollars are issued online. It's a form of centralized digital scarcity as well, whereas gold is physical scarcity based. And Bitcoin is decentralized digital scarcity, okay? And there's 4 layers to that that we're gonna go through. So first of all, and we're gonna go through all of these one after the other. So there's 4 kind of like main aspects to Bitcoin's scarcity. The first is that, well, first of all, Satoshi invented the possibility of decentralized digital scarcity in the first place, which we're going to see. The properties that make Bitcoin valuable, that give people faith in Bitcoin's future purchasing power, that give people faith in the fact that they will be able to spend their Bitcoin, it won't be seized, it won't be stopped, it won't be controlled by the government or anyway. These properties are scarce. Right? So number 1, Satoshi invents scarcity. Number 2, the features of Bitcoin are scarce. right? Number 3, the fixed monetary supply of Bitcoin is itself unmovable. And number 4, the creation and genesis of Bitcoin cannot be reproduced. It's a unique event. It's a serendipitous event. So let's talk about decentralized digital scarcity. So, I mean, the whole point of Bitcoin was to be able to create assets online which cannot be counterfeited and which do not require a trusted third party to validate as being authentic, and to prevent the double spend problem. And there's a reason why we didn't see this, like the emergence of assets and shitcoins and ICOs and blockchain tokens before Bitcoin, is because it just didn't exist. Like there was no, in order for Bitcoin's scarcity to emerge, in other words, it needs to become possible, right? So I'm gonna explain like very quickly like the double spend problem using a Tim Hortons gift card, right? So if you receive a gift card from Tim Hortons, what you really have is at the back, you'll have a barcode and it's gonna have like a 16-digit code to it. So the central bank of Tim Hortons gift card, which is Tim Hortons, has issued a new unit of currency. The gift card has $10 on it. And if you wanna like buy it from someone else, let's say someone has received a gift card and he doesn't want it anymore, and he's like, yo, I have a $10 gift card, you know, just give me $8 and I'll give you my $10 gift card. I don't like Tim Hortons coffee. So you can give him $8 and he gives you the gift card, right? And then you go to the Tim Hortons and you go to spend it, and Tim Hortons is like, no, it's already been spent. And you're like, what do you mean? Because obviously if he gives you the gift card, what prevents him from taking a photo of the gift card and going to the Tim Hortons and asking the cashier to scan that thing on his phone, which is just a photo of the gift card, or to enter the number of the gift card online, right? So obviously there's a rule in any kind of money. Is the first person to spend it is the first one who gets it, because if he sells you the gift card for cash and before you have time to go to the Tim Hortons and use that gift card, he went to the Tim Hortons, he already claimed the gift card, he left with 3 coffees, you know, he's gone. There's nothing you can do. Like the coffees have been drunk, like it's all gone. So he's the guy who got to spend the money and you didn't. So he double spent that gift card, right? So you can copy the asset in an unlimited way, and it's very easy to understand. Anything that's online that's digital can be copied infinitely, right? That's why a song has no value. Like imagine giving someone a song, buying a song for like $5, when you can obviously just, you know, buy a copy of that song for free or copy that song for free. And like, so we noticed this with the emergence of like BitTorrent, for example, that even digital assets like songs, they tried to make them, you know, unique, and you can only listen to, you know, the hardware for listening to digital, you know, MP3 players had some technologies that would try to make sure that they were unique, but you can't make something infinitely copyable without effort unique on the internet, even if you try. Right, and then in Satoshi's white paper, he advertises Bitcoin's main feature as being to solving the double spend problem. Interestingly, by the way, Satoshi does not talk about scarcity of money at all before creating Bitcoin, which gives us an idea that perhaps the scarcity of Bitcoin, like the sound money aspect of Bitcoin, just kind of emerged from Bitcoin, and it wasn't his specific primary intent. But whether or not it was his intent or not, he made it possible with the invention of decentralized digital scarcity. And this needs to be able to have it without any third party. So in our example here, like the third party is the Tim Hortons bank, but obviously we're talking about central banks. So currently that's what central banks do and banks do. So the bank keeps the records of all its users and who owns the money. So when you do an e-transfer out of your bank account, like the bank will remove that amount from the balance. They are making sure that you can't spend it twice. And then the central bank makes sure that the banks don't spend it twice. So ultimately, all the flows of the transaction flows go through that one central entity at the end, which is the Central Bank of Canada. And even that central bank, ultimately, there are other central banks like the Bank of International Settlement that make sure that the central banks between each other don't double spend each other. So it's kind of like a pyramid layer, hierarchy layer of a centralized permission-based validation and protection of counterfeiting. Okay, so number two, and the way by which we create decentralized digital scarcity in Bitcoin, what was Satoshi's like monumental achievement or main achievement is a consensus mechanism on which transaction is a valid transaction and who the money belongs to, right? So the answer to how do we prevent counterfeiting online without a trusted third party is that we have a consensus network where everyone agrees which money is correct, which money is not correct. So if everybody agrees, we don't need a single entity to agree. And the process by which this is created is fairly complex. I refer to it as the Nakamoto consensus system. But the important thing is that it does work, right? So there's no, at every 10 minutes, everybody agrees on the state of transactions and there's no disagreement in Bitcoin. It just doesn't happen. So, okay, we have properties of Bitcoin which people ascribe value to, right? So, so for something to have a price, it needs to have a supply and demand, right? So the supply of Bitcoin is fixed, as we'll see in the next slides, but why do people value Bitcoin? What gives them faith that they're actually going to be able to use it? And Bitcoin also has an underlying network. It's not only an asset, it has a network. There is a transactional network, and there are transactional networks with an S, which can only be used if you use Bitcoin as a currency. So you can use the on-chain Bitcoin network. You can use the Lightning network. You can use the Liquid network. You can transact Bitcoin peer-to-peer. So when we're talking about like Bitcoin, we're talking about like Bitcoin is also an open source software project. It's an open protocol and it has a bunch of features. So, censorship resistance is often argued as Bitcoin's key feature. Well, it is, because if it wasn't censorship resistant, it would not exist, right? So Bitcoin transactions are a form of speech, because when you're sending money to someone, you actually announce to the network that your intent to transfer money from your public key to someone else's public key. So a Bitcoin transaction is a message. It actually is on the network. So it's not just like a philosophical thing. It is actually just a message. And in order for Bitcoin to exist, people must be able to use it without requiring permission and without having their transactional networks closed down or their assets seized. So where does this come from in Bitcoin? Well, first of all, Bitcoin has a very open source, robust ecosystem of software. In Bitcoin, you can run your own node fairly easily. So you can access the network and broadcast transactions and validate transactions yourself extremely easily. And this is not something that's easy to code, right? For example, you can't just code the software and have like, all right, well, this must be, we're going to tweak the parameters for it to be, easier to run a node. It's like, no, you need to, first of all, in the case of Bitcoin, agree to a block size limit. For Bitcoin to be censorship resistant, people need to agree not to change the rules of the block size and keep a block size limit low. You need people to, you need the network to be simple enough and minimalist enough for people to be able to do that without a third party. In Ethereum, for example, Ethereum is not censorship resistant because most, like the vast majority, and we're talking about like 99.999% of all Ethereum users or uses are done through the node of a third party. So when you're looking at your wallet and you're looking at your shitcoins in your wallet or your shit NFTs or whatever, and you want to send them or receive them or want to do anything like this, like you're connecting to a third party, which is itself connecting to the Ethereum network, because the Ethereum network is so cluttered, and supposedly they have like the most sophisticated engineers in the world at networking, and they still can't engineer a censorship-resistant network. So it's very, very difficult. Like censorship resistance is not something that happens like this, right? Like out of the bat. It's something that's developed over time. In the case of Bitcoin, we've had, I think I have a slide here. Like we had this event called the user activated soft fork and the two SegWit2x soft forks, which were attempts at censoring Bitcoin. The No2x hard fork was an attempt to take over Bitcoin and centralizing Bitcoin. Essentially, they wanted the miners wanted to centralize Bitcoin, and it took like a year and a half, like 2 years almost, for Bitcoin to obtain the antibodies necessary to reject these kind of takeovers. And they had been building for a while. So censorship resistance is not, you can't just decide to be censorship resistant. It's kind of hard to explain, but it's definitely a feature that emerges over time. So immutability is also an emergent property. So when you send a Bitcoin transaction to someone and it's confirmed in the blockchain, you can trust that it will not be reversed. It is immutable. And why do you trust that? Well, again, that's the entire kind of like complex game theory behind Bitcoin. Well, first of all, there's the miners have incentive not to reverse. The users have incentives not to have the transactions reversed. The exchanges and the services providers have an incentive not to have transactions reversed. The software will be able to detect if the transactions have been reversed, and you can take action. And technically, like, think about this as what prevents a 51% attack on Bitcoin. Okay, that's what we're talking about when we're talking about immutability. We're talking about resistance to a 51% attack. The cost of a 51% attack are extremely high the more hashing power there is. Right here, for example, there's a good graph here. All right, so you have people who adopt Bitcoin, they hold the Bitcoin, the price of the Bitcoin goes higher because because there's no one selling it, right? It removes pressure on the sell pressure on the market when people hold Bitcoin for the long term. This makes Bitcoin mining more profitable, which increases the hash rate, which increases the security of the network, which increases the legitimacy, and so on. And so it's like there's multiple networks of network effects happening here, which ultimately increase the hash power, increase the economic incentives that are not to have the network cheated. And at the end of the day, it is so insanely difficult to pull off a 51% attack on Bitcoin that people just don't do it. But you can't make your coin 51% attack resistant. You need to have skin in the game. You need to have a lot of security, a lot of hash power. I guess point number 2 and point number 5 are kind of similar in respect. Immutability, there's also something, immutability refers to the consensus rules of Bitcoin. So, a good question that a lot of people ask is, right, if, great point. Okay, so if you're pitching Bitcoin to someone, and if you had to pick one argument for them, the one I use all the time is, well, there's only 21 million. Think about it. There's only 21 million. In the future, will people want more or less Bitcoin? That's the framework that I use to convince people. All right, if there's only 21 million, and in the future people want more Bitcoin, then obviously the price will go up. If they want less Bitcoin, then the price will go down. But seeing as Bitcoin has these properties that you like, which are, you know, the ability to transact, we can safely assume that people will want more. And then the person will say, well, you know, you said that there's only 21 million Bitcoin, and you also said that Bitcoin is open source and anybody can modify the code. So why doesn't someone just modify the code to double the amount of Bitcoins? Well, they have already done that, and it's called shitcoins. But Bitcoin itself, the rules are 100% immutable. Again, why? Well, Bitcoin's governance mechanism prevents it from just being hard forked, right? You can't change the rules of Bitcoin and make it accepted by the population as still being Bitcoin, right? I'll give you a really good example of, so that's what they wanted to do. That's what the attackers that attacked Bitcoin in 2017, like Coinbase and BitPay, Blockchain.info, BitGo, a bunch of these companies. There were other companies that participated in this kind of attack. What they wanted to do, they wanted to change the rules of Bitcoin and double the size of the blocks to make Bitcoin, like, you know, presumably faster, like more transactions per second. To double the size of the blocks in Bitcoin is technically a very similar upgrade than to double the amount of Bitcoins created every 10 minutes. It's not that different in terms of just like logistics, right? Of how to change the code of Bitcoin. These are consensus rules. Both of them are consensus rules. And that was fought off for 2 years. And I'm not going to go into the whole details of how that happened. I actually just, for the Francophones, I just did a podcast on this with Parlons Bitcoin. But if you're interested in this, just Google like UASF No2X recap, stuff like that. Just read into the story of this. But just changing that rule, the block size, created a civil war which lasted almost 2 years. So imagine upgrading, changing Bitcoin's monetary policy, and ultimately, what the attackers were doing, they were saying, "Okay, we're gonna hard fork Bitcoin," and what we would have normally said is, "All right, good luck with your shitcoin. We don't give a fuck. Do whatever you fuck you want." But the problem was that these companies were saying, all right, we're going to hard fork Bitcoin and we're still going to call it Bitcoin. And that was a problem. Because if Coinbase says, oh, we want to change Bitcoin, we're going to tweak it and we're going to call it Bitcoin Pro or Bitcoin Cash or like, you know, Fast Coin or VC Coin or whatever the fuck they want, then who cares? But they were going to use their company, Coinbase, which is huge, to call their new chain, their new currency, Bitcoin. They're going to steal the brand of Bitcoin and then create this whole confusion, which was why there was such a big fight. Because if they hadn't had the idea to like believe that their new thing was Bitcoin, then nobody would have cared. That's what they did with Ethereum. With Ethereum, they went from Ethereum 1.0 to Ethereum 2.0. And I'm sorry, but Ethereum 2.0 is not Ethereum. It is not the same as before. Ethereum has changed monetary policies multiple times. Can you name the monetary policy of Ethereum? No. Do you know how it has changed over time? No. So the rules have changed. The name has remained. The brand has remained. They've essentially usurped the network effect of Ethereum's brand with these new rules. So Ethereum rules are not immutable. They do change. Ethereum transactions are not immutable. They are reversible. It has happened. Even though they argue that they are immutable and they want it to be immutable, they can't make it happen. So trustless validation, very similar to censorship resistance. So you can validate everything in Bitcoin without a third party. That might not be as emergent as the other properties because that's definitely a function of just cryptography in general. But what makes it emergent is that you're able to run your own node. So privacy is also an emergent property. People will argue, oh, Monero is more private than Bitcoin. Really? Because nobody accepts Monero for payments. Nobody's holding Monero long term. Anybody that's like buying drugs with Monero, first of all, it's like, where are you going to buy Monero in the first place? On an exchange with KYC? No. Okay, you're going to go to some peer-to-peer platform. Have you seen how little liquidity there is? You're going to buy Bitcoin first, and then you're going to exchange that Bitcoin for Monero, and then you're going to buy your drugs. The drug dealer is going to accept Monero. What's he going to do with that? Of course, he's going to switch it right away to Bitcoin because Monero is not liquid, right? So what's the whole point of Monero if you're going to be using Bitcoin to get in and out of Monero? Because Monero is not liquid. Because Monero doesn't have a network effect. And in privacy, liquidity is also called anonymity set, right? So, okay, another thing. If there's only like one place where everybody's buying and exchanging Monero for Bitcoin, which is like the BISC, decentralized peer-to-peer exchange, then all you have to do is just, if you're like the government, you just go on that exchange and you pretend to pose as a Monero seller, and then you just keep track of whoever's buying and selling Monero, and you keep track of the Bitcoin transaction that was associated with that trade. And then in that case, you're already tracked. So you know what I mean? Like, you can't just code in privacy features, because privacy depends on you being able to obfuscate. You need a lot of other people to use Monero to be able to obfuscate yourself. You need plausible deniability, and you need liquidity. And security obviously is the hash rate. You can't code hash rate. You can't buy hash rate. The hash rate has to emerge naturally. So that's, security is hash rate. So and then these properties are what guarantees scarcity, Bitcoin scarcity. Because think about it. Why can't I create Bitcoins out of thin air? Well, because there's a security component to it, because you can't force your will upon it. Because even if you try to force your will upon it, how are you going to force your will if people are anonymous? Right? If people are private, you can't find the Bitcoin users because it's private. You can't reverse Bitcoin transactions and try to fuck with the network because it's immutable. You can't ask other people to trust you and to start, centralizing the validation process like they did in Ethereum, because Bitcoin has trustless validation. You can't censor blocks of transactions. You can't censor payments. You don't have any leverage to control the rules of Bitcoin. So the rules of Bitcoin could never change because of all these features. And there are also the same features that people value, which increase the demand for Bitcoin, which obviously is a self-reinforcing network effect between those two things. So point number 3. All right, so I guess the point here that I was trying to make, just to recap, is that the properties that we like about Bitcoin and the properties that make Bitcoin impossible to increase the amount of Bitcoins in circulation, so the stability of the monetary policy and the features that people value, are emergent, right? They out of the interaction of the participants, they are created. Bitcoin in the beginning was not censorship resistant. It was not private. It was not trustless because there were so few participants. And over time, these properties came out of nowhere, essentially. Well, they didn't come out of nowhere. They came out of the interaction of countless participants in the peer-to-peer network, but it feels like they came out of nowhere. Austrian economics talk about this all the time, by the way, like emergence. Hayek has a really good quote about it where he talks about things. It looks like there's no identifiable conductor. It's like there's this grand symphony of the universe, and all the musicians are playing together without the appearance of a conductor. Think about the free market, right? So how does the price of coffee cup emerge through price is an emergent phenomenon. Think about languages, right? The English language. Where did the English language come from? There was not a point where a group sat down and created the English language. It just emerged over time. Think about natural selection of animals. Like, was there a point where the rabbit was designed? Did anybody design the rabbit? No, the rabbit was not designed. The rabbit emerged from competition between species. Same for the features of Bitcoin. Okay, so I think I've already kind of covered the third point. So Bitcoin, you know, the most basic way to say, why is Bitcoin scarce? Well, it has 21 million Bitcoins. Okay, but then again, why does it have 21 million Bitcoins? Because we agree on it and we agree not to increase it. So that's the important part of it's not the 21 million Bitcoin itself, because there could have been, I mean, so Satoshi chose a deflationary curve, or he chose to have the increase of Bitcoin to decrease over time. He could have chosen a linear curve. He could have chosen an exponential curve, but he did choose a logarithmic issuance or a deflationary curve, which mimics kind of like the gold curve. So if you look at this chart, you say, oh, well, this is why Bitcoin is scarce. But what's really important is that this cannot be changed, right? When you think about, Saifedean has a concept which is like stock to flow, which is if you compare different types of money over time, what is the amount of money that's created, like new units versus the existing amount of units. With gold, you can't really predict that, right? You can't predict how much gold is going to be created in the future, because there could be some technology that is created that creates more units of gold, that we could go find gold in the ocean. We could go find gold in volcanoes, for all I know. For asteroids, that's something that's often talked about. With Bitcoin and with dollars, how many dollars are going to be there in the future? Like, you have no idea, right? That's just up to some political person. But with Bitcoin, you know what it's going to be because it's programmed into the software. So this curve, the money supply inflation curve, is actually programmed into the software. It's too bad I don't have a screenshot, but there's actually a part of the code where it says, all right, you're going to, start with 50 and then divide by 2 every X amount of blocks. So the monetary policy is coded in. But if you look at, for example, like Ethereum, again, that changes over time. The curve changes over time. You thought the curve was going to look like this, but it doesn't actually look like this after the new change, right? So how do you prevent the money from being changed? Well, you can't, unless it's fully decentralized and fully censorship resistant. If you have some centralization is going to creep in, and eventually people are going to change the monetary policy. Right, and last point of Bitcoin's scarcity. So when Bitcoin was created, it was vulnerable. Nobody knew, but nobody knew about it and nobody cared, right? So if you're gonna launch Bitcoin today, like anybody with one ASIC, one miner in his home, if you go back in time and it's like 2009, you bring back in time like one miner, you can completely destroy Bitcoin from day one, right? Because you know how it works. You have a miner that's like the product of years and years and years and years of work and research. Bitcoin has a very low hash power. You can spin up hundreds of nodes on the network. You can mine. You can split the blockchain. You can make orphan blocks. You can do all sorts of shenanigans to attack Bitcoin. But at the time, especially if you're a government, it's like game over, right? If you're like the US government and you go back in time and you try to kill Bitcoin, I mean, it's going to take you 5 minutes to kill Bitcoin because there's one developer, there's a few nodes, there's very little hashing power. Like Bitcoins themselves have no value, so there's nothing to lose. The people have nothing. You know what I mean? There's this. So the context by which Bitcoin was created was Satoshi was able to make Bitcoin grow naturally. Think of it like as a baby who's like walking around and developing an immune system naturally over time, right? Because there's no crazy disease and there's no predators out there that are trying to eat the baby. You know, it's like, whereas today, if you were to launch a coin, you would need to make a compromise to say, well, we can't have it completely vulnerable and open and decentralized. We need to give it some extra protection. And to give it some extra protection against attack by decentralized attackers, we need some kind of centralization. This is what the coins are always doing these days, right? Like in order for their coin not to be attacked, they make compromises in the design of the coin so that there is a governance mechanism by which these attacks are prevented. So essentially, they make it more centralized. So Bitcoin has no pre-mine because of this. That's why other coins have pre-mines, right? Because other coins are trying to bootstrap skin in the game up front by giving people, and obviously if you're going to issue a pre-mine, it's centralized from the beginning because who's issuing the pre-mine, right? So Bitcoin's distribution, right, is also unique. It's the only coin that has no pre-mine and no centralization. There are some, to be fair, maybe one or two or three that don't have a pre-mine, but they're not decentralized. They're not. They look decentralized now, but mostly because people don't care enough to govern them or to attack them. For example, Monero. But Satoshi's fair distribution, the fact that he did not himself keep a portion of the coins, he never spent them, you can't reproduce that. He's an irreproachable founder that disappeared. I'm sorry, it sounds like it's not a big deal, but it's a massive, massive deal because we have this Genesis story, which is irreproachable from the start. The foundations of Bitcoin are pure ethical, purely moral, and that can never be questioned because the founder literally killed himself, right? He killed his character, Satoshi, because that's what needed to be done. And in the beginning, how do you bootstrap a community? Well, in the shitcoin world, you fucking pay them, right? You issue the ICO, you raise money from the VCs that are trying to launder money, that are trying to get rich quick. You grab their fiat dollars that were printed by the US central banks, and you give it to people, to the devs. You spend marketing money. You know, that's why, like, I don't know if you guys remember the ICO era. They would raise like $100 million and then spend all of that money on developers and marketing and infrastructure and partnerships for what? Nothing. Nothing came out of that, right? Whereas Bitcoin had no pre-mine and had no way of rewarding people other than proof of work, right? The mining. So how do you bootstrap that? Well, with ideological commitment. So the people who were working on Bitcoin in the beginning were doing so at a loss. I mean, don't get me wrong. Some of them were visionaries, like Hal Finney, like Mircea Popescu, and they thought, holy shit, like my Bitcoin is going to be worth $1 million in the future. And right now it's worth like less than a cent. So they were greedy. They did understand that. But most people were contributing to Bitcoin because it was fun, because they were cypherpunk and libertarians, because they wanted to destroy the government. Think about like the founder of Silk Road, right? Huge, huge contribution to Bitcoin. He gave his life for Bitcoin, right? Why was he in Bitcoin in the first place? Because he was in it for the values and the ethics and the morals of Bitcoin, right? So another thing is there's only one first and oldest cryptocurrency. That's just true, right? You have multiple. There's also, only one second oldest currency, obviously, but who gives a fuck about that? You know what I mean? Like do you remember in 2007 who was the second runoff winner to the Stanley Cup? No, you only remember the winners, obviously. That's what, and all of this is, a lot of this is psychology, right? We're talking about why do people spontaneously congregate towards Bitcoin as money? A lot of this is psychological and subconscious, right? It's only going to be one person only. And that means that there's Bitcoin and there's shitcoin. And this has been a big cultural shift, right? So there's one category that you have Bitcoin, and then you have all sorts of shitcoins that are competing to be Bitcoin. But Bitcoin does not compete with any of the shitcoins. The shitcoins compete between themselves to determine who's the best runner-up to Bitcoin, but you can't. I think that kind of covers what I wanted to say about Bitcoin's scarcity. There's another point I wanted to make about Bitcoin scarcity, but I think that's pretty much it. Let's see if I have other stuff in here. Right, okay, so the Immaculate Conception of Bitcoin, this foundational story is fantastic, I love it. And regarding the altcoins, there's something that really annoys me, all right, is that all of these people say that, my shitcoin is scarce. It only has 42 million shitcoins, right? Look at Ethereum. It's scarce because the monetary policy of Ethereum means that there's a limited amount of it, okay? Who cares, right? Because you can fork Ethereum and create some shit like Cardano, some shit like EOS, or some shit like Tron or Binance Chain. So the features that make Bitcoin valuable, censorship resistance, immutability, trustless validation, privacy, security, they can't be created. But the features that make Ethereum valuable, which is, you can issue shitcoins onto it, and it has nice mobile wallets, and you can buy and sell it on an exchange. These are things that, this is why people value Ethereum. They value Ethereum because it allows them to issue shitcoins, and there's mobile wallets that allow them to connect to exchanges. That's literally what people use Ethereum for, to issue shitcoins and issue shit tokens and to buy and sell them on the exchange. You can do that with EOS. You can do that with Tron. You can do that with Binance Chain. With Bitcoin, you can fight governments. You can avoid censorship. You can protect your assets from being frozen. You can't do that with Dogecoin. You can't do that with Litecoin. You can't do that with your other coins because these are all vulnerable to having their monetary policy attacked, to having their hash rate attacked, to having the validation of it attacked, and all sorts of attacks, which Bitcoin is not vulnerable to. So if you can fork a coin and the new coin has the same properties as the old coin, then it's not scarce. It doesn't matter. It doesn't matter, right? So if you have Dogecoin and you create Dogecoin 2, and Dogecoin 2 is just as good as Dogecoin, and people value it just as much as Dogecoin, then you've just doubled the amount of Dogecoins because you have twice the amount of supply for the same thing that people value, the same demand. So that's why it really grinds my gears when people say Litecoin is scarce. There's only 42 million Litecoin. Okay, but how many copies of Litecoin have been made? Like Dogecoin, right? For example, is a great one, right? So when Dogecoin was created, the Litecoin supply was effectively the supply for cheap clones of Bitcoin, right? So what is the value proposition of Dogecoin? Well, it's a cheaper clone of Bitcoin. Well, you can have an infinite amount of cheaper clones of Bitcoin, but you can only have one Bitcoin, right? So just because you code in something, right? Just because you have a monetary policy that's coded in and programmed into the software, it doesn't mean anything if anybody can create a similar token from scratch, which fulfills the same demand. So if you go back to the start, I hope this was kind of clear, is that Bitcoin's scarcity is an emergent feature. It was not engineered. It was not decided to be scarce. It just emerged as being irreproducible. So why is it scarce? It's because you can't reproduce it. You can't reproduce Bitcoins. You can't create more Bitcoins within the network. So within Bitcoin, you can't create more Bitcoins. but also you cannot create copies of Bitcoin that are just as good. And it's really important to realize that when people are making a decision about what money they're going to put their savings in, they're not making the same decision of what network effect, what social network they're going to be using, right? Because, you know, if you're deciding on whether or not you're going to spend your time on Facebook or LinkedIn or Twitter, you're thinking, oh well, you know, I have a cost, and the risk is like I may be left out of some of my friends. I'm not going to be able to talk to some of my friends. So I have a lot of friends that are from Europe and they use LinkedIn. I have a lot of friends that are from South America. They use like WhatsApp and Facebook. And I have a lot of friends from the US that use Twitter. So if I, you know, go on Facebook, well, I might miss out on some interactions with my friends from the US. But you can have Facebook, Twitter, and LinkedIn like at the same time. That's kind of like not a huge deal. Your time is scarce, but you can still move between those networks really easily. So it's not a big choice. And another kind of network is languages. Languages is a lot more tricky, right? Because if I choose to learn Spanish over Italian, I'm dedicating a lot of my life to learning Spanish. It's a lot of time. It's a lot of mental energy. And I can only hold so many languages in my head. And I certainly can't learn 2 languages at the same time. That's very, very difficult to learn 2 languages at the same time. And, you know, realistically, like you can only learn like 2 or 3 languages in your life outside of your primary language. Even most people can't even learn another one. Right? So when you're learning language, you're making a big decision. You're putting a lot at stake, a lot at risk. But when you're choosing money, you're putting everything at risk, everything at stake. Because if I decide that I'm going to save my wealth with Bcash, at the time where Bcash forked, for example, the time when Bitcoin was split, a bunch of people changed the rules of Bitcoin and they created their clone called Bitcoin Cash. If you had invested your money in Bcash at that time, today, you would have lost 95% or 90% of all the money you have. And one day you will lose 100%. It is not an exaggeration to say that making the wrong choice of money can kill you. It can kill you. Think about the Venezuelans that decided to keep their money in pesos versus dollars 15 years ago. Some of them are dead because of that decision. So it's not a decision that's done lightly, right? It's not a decision like the strongest network effect in the world is the network effect of money. So in order for one person to move from one to the other, you need to have like an overwhelming incentive to change network effects, which is, for example, what we're seeing now from dollars to Bitcoin. Like, it's very, very risky to get into Bitcoin because if Bitcoin collapses, then you lost. Well, that was the case before, obviously. Now it's not that much because the overwhelming incentive is that the US dollar is collapsing. So why would you go on the lifeboat of Bitcoin? Well, it's because the other one is collapsing, so I have no choice. It's like you need to have no choice to move to a new network effect when it comes to money. You have like 1 to 5% of the early adopters that are going to be visionaries, that are going to be like, holy shit, like people will not have any choice in the future. I still have a choice today, but people won't in the future. So I'm going to make that choice now. So I can, as I said in the beginning, get more of the units for myself now than my future self will be able to get for himself. So the network effect is huge, huge, huge. And if you're going to create a clone of Bitcoin, I don't believe that you're going to be able to create what people value, which is clearly we've established, the market has established that. It's privacy, censorship resistance, and essentially being non-controlled by government and immutable. That's what people want. But even if you were able somehow to create those features, you can never replicate the network effect of the existing stuff that's already into Bitcoin. So I hope that covers why Bitcoin scarcity is emergent and it can't be reproduced. Thank you very much.
Thank you, Francis. As always, it's always it's doing this feedback. Yeah, thank you, Francis, for giving this presentation. As always, it's really insightful and powerful, and it goes beyond like just like a really simple approach to what is Bitcoin. And I hope that some people in the room have really grasped what is Bitcoin, and I hope they understand more. So I don't know if you have any question, guys, in the audience.
I'd like to get one. Yeah. Francis, can you, because you compared with gold earlier, and we know that gold was well, humanity prospered on gold standard for a while, but eventually, if I'm not mistaken, it ended up having a single point of failure with central banks, I believe. And so, why is Bitcoin immune to that vulnerability eventually? Can you describe that?
Right. So there's many things that led to that. First of all, the confiscation of gold. The first Executive Order 6102, which, if someone can pull up, I believe was in 1932. So it was determined that the government can't seize everybody's gold reserves. And once it has all the gold reserves in its stock, then it's much easier to control like gold policies. 2, you cannot validate gold transactions or real gold transactions. You cannot validate that that gold, like if someone has gold in a safe, they can't prove that they have gold in a safe. So what they did is essentially they centralized the gold supply. They issued digital representations of that gold, which were bonds and certificates. They based currencies on those gold deposits. And they inflated the amount of gold deposits and derivatives of that gold. And people were not able to validate which one was real gold, which one was fake gold, which one was backed or which one wasn't. So I guess the quick answer is gold. You cannot validate gold. You cannot, well, you can't create digital gold without a third party also, right? So imagine from a global macroeconomic point of view, like you have gold, which is like the properties of gold as money only work when you physically are able to validate it, and when you physically exchange the metal. When you exchange like representations of the metal, the properties that used to make gold what people wanted are gone, right? Because you cannot validate it. One of the reasons why gold emerged as money is because it has a very low melting point. So it's really easy for anyone at home to like melt down gold and check the purity of gold. It's not something that, I mean, now you do it with fancy machines, but people used to be able to do it fairly easily, like at home with a high degree of certainty. So I think it's the transformation of the economy to a globalized digital economy where gold, in order to still be a useful medium of exchange, needed to be like centralized and have digital representations, and that just ruined all the possibilities of gold being used as also a store of value. Because if you can create copies of gold, like digital copies of gold, and people can't tell the difference between that and real gold, then you're essentially creating fake gold, right? You're increasing the supply of gold in a way. So if you look at the supply of gold denominated financial instruments versus the supply of gold, like the supply of gold denominated instruments is like far higher, and people can't validate.
Great. Another question, guys?
Just a simple question. You talked about a video that you made, I don't know when, but I need to find it. And what's the name of it? Something like with the NO2X or something like that?
Yeah.
What's the name of the video?
I'll try to make sure that we put it in the comments of the video and that the attendees of the conference have some material on that. Unfortunately, there's a lot of them in French. It is the podcast Parlons Bitcoin. the latest episode. It just came out a few days ago. So if you're a Francophone, Emmanuel is the host of the podcast. I spent 3 hours on this topic, specifically just this one, No2X and UASF. Otherwise, I would just Google UASF No2X and start the rabbit hole from there. But if you're Francophone, just Google Parlons Bitcoin and my name, Francis Pouliot.
Perfect.
And the episode is episode 21.
Great, awesome, thanks.
I haven't read that book, but I haven't seen people that were involved in the block size war complain about it. And knowing the Bitcoin community, if the book was inaccurate, we probably would have known. I probably would have known. So I haven't read it, so I can't recommend it. But I can recommend it to the degree that it seems like it's a good representation. And just as a side note, like, just the fact that there's a book about this should tell you how important it is. And just to like top it off, like the fact that we won the block size war, that Bitcoin was not modified, was not taken over, is the most bullish thing that ever happened to Bitcoin. I mean, I'm not the only person that just completely went full bullish after this happened, because it's like this could never, ever, ever have happened in any other blockchain or altcoin. So block size war, yeah, great comment, Maciek. I would encourage people to read it. I'm sure it's good.
Great. Another question?
Oui, salut Francis. Do you think Bitcoin can be overtaken by like new technologies? I have in mind quantum computers.
Merci. By the way, is this GF?
Yes.
Hey, I recognize your voice. Cool. Well, no. Well, of course, yes. So quantum computing can break digital signatures. It can't break the mining process. So if you're doing quantum computing on Bitcoin, what you really would be doing, it would be cracking like Bitcoin private keys. That is a concern. I mean, I personally talked to an expert from Montreal, a world-renowned expert from Montreal in quantum computing. And in private, he was telling me that, the chance of that happening within the next 20 years is so incredibly small. A lot of people's expectation of quantum computing is based on kind of like fiction. But of course, theoretically, yes. Theoretically, you can crack Bitcoin private keys. If that possibility emerges, there's two things. First of all, the entire world economy collapses, regardless of Bitcoin, because if the technology is good enough to crack Bitcoin private keys, it will absolutely crack all encryption on the internet, all encryption anywhere, and everybody's secrets are revealed. The financial system is utterly, completely destroyed. And Bitcoin will be severely affected by this, or could be severely affected by this. The difference is that Bitcoin can be upgraded to other cryptographic algorithms, which are more resistant. In that case, that would be a hard fork of Bitcoin. But yeah, I mean, if quantum computing ever emerges to a degree where it can attack Bitcoin, the rest of the system is completely fucked. B, Bitcoin can adapt. This is not a satisfactory solution, obviously, but it's also because I think the probability of quantum computing being able to do that is very low.
Great. So we have a question from the live stream. Somebody's asking, in what time frame will governments attempt to ban Bitcoin? What are recommendations for users?
Well, they've already attempted it, right? So I think they're doing pretty much as they can do right now, because they can't ban it. It's very, very, very difficult to ban its use because it's easy to circumvent the use of Bitcoin. They can ban the purchase and sale of Bitcoin. They could totally shut down Bull Bitcoin and all the other exchanges, but then they would allow a very big black market to emerge. And it's absolutely certain that a gigantic black market would emerge. That's not something that they can stop. So what they're doing is they're regulating the purchase and sale of Bitcoin to make sure that they can track large amounts, like over $10,000, and they can. I think that's kind of like the worst. I think that they're gonna do. I think what they're gonna probably do is tax Bitcoiners, like go really hard on taxing Bitcoiners. I think that's another step that they might be going for. But like in terms of like attacking Bitcoin or like censoring, or they've already done pretty much all that they can do, which is just regulate the purchase and sale, because that's the one point of failure of Bitcoin, is that to get it, to acquire it without censorship, you can mine it, right? So if people ban like buying Bitcoin, then people are just gonna mine it at home, right? I mean, you're gonna buy a miner, plug it in your house, and like, what are people gonna do? And you can earn it as a salary, right? So you can do jobs on the internet and like get paid with Bitcoin. These are ways to acquire Bitcoin without buying it that are very difficult to censor. But buying and selling is the way they would go. What I recommend is 3 things. One of them is always hold your own keys, because whatever the government decides to do and whatever we're forced to do, if you hold your own keys, you can make your own decision, right? If you don't hold your own keys and you leave your Bitcoins on an exchange, the exchange is going to decide for you what happens to that, right? Run your own node, because if the government is trying to attack Bitcoin, one of the ways they would do is fuck with the network, right? And try to disrupt the network, and maybe try to disrupt centralized services that you're relying on with your wallet. For example, attacking your wallets. The government can't attack a wallet. The company that runs the wallet that you're using can be attacked by the government. Running your own Bitcoin full node, you can't be attacked. And 3 is have some proper blockchain privacy hygiene. And this is not only talking about governments becoming tyrannical and attacking you. This is also to protect yourself from scammers, fraudsters, from your wife or your friends tracking your transactions, or from protecting yourself from other businesses that are trying to spy on you. Protect yourself from criminals that are trying to figure out how much money you have to rob your house. You should take care of your blockchain hygiene using Bitcoin. That means using CoinJoin technologies. So I would say like very easy way to do this is you use like Wasabi Wallet for privacy. You run your own Bitcoin full node on your computer. Wasabi Wallet will connect to it automatically. And you keep your coins either in Wasabi Wallet or in a hardware wallet. But to summarize, just use Bitcoin correctly and you're fine. So hold your own keys, run your own node, and make sure that your privacy is you don't make any privacy mistakes.
Great. Any other question?
Any other question in the room?
Okay, we have one question on the live stream again. What is, in your opinion, the biggest threat, and what's your view on it?
The biggest threat to Bitcoin?
Yeah, sorry.
It's a good question. At this point, I don't think there's a real threat to Bitcoin. I think there's a threat to Bitcoiners, right? So I think the biggest threat to Bitcoin is that the individual participants in the network are attacked so relentlessly and so violently that it discourages the use of Bitcoin. Think about it, like what's the biggest threat to a religion? Well, it's that you kill the priests and you burn the churches so that people are too afraid to go to the religion. You can't kill a religion, but you can make people afraid to go pray. You know what I mean? So you can make people afraid to use Bitcoin. But even then, I mean, honestly, is that really a threat to Bitcoin? Not really. It's just a threat to Bitcoiners. A threat to Bitcoin would be the price, like if the price of Bitcoin goes to like $1 million right away and everybody gets onto Bitcoin today, it would be pretty centralized. So I would say, yeah, I would say the biggest threat to Bitcoin is centralization. Centralization of nodes, centralization of economic nodes. Probably number one, people not fully running nodes and delegating their validation to third parties could be a threat. But realistically, I don't see any major threat to Bitcoin itself at this point. I think the threat is mostly to Bitcoiners. I think if someone wants to attack Bitcoin, they're going to attack individual Bitcoiners, and their strategy is not going to be to destroy Bitcoin, but to delay adoption, right? So attackers of Bitcoin, they're going to delay it, not destroy it. So if you personally are able to outlast the attackers, you will be fine. People that will not be able to outlast the attackers will not be fine. This means that Bitcoin might take off a long time in the future instead of sooner. And it means that people are going to be victims. Not everybody's going to be safe. But again, run your own keys, run your own nodes, and coin join. And wait. Try to outlast the government, outlast the attackers.
Okay, great. Maybe one last question from the live stream again. Francis, have you or has your entourage orange pilled Duhem or Bernier yet?
I've done both.
That's good.
Yes.
Okay, so maybe if there's anything in the audience, but maybe we're gonna finish here. Yeah, no more question. Okay, great. Well, that sums up the fourth day of the Bitcoin summer. So thank you again,
Thanks,
Francis, and we can give them a round of applause. So thank you. Oh, he left. All right, guys. So thank you again for being here. As you may know, some of you are reaching the Indian restaurant. If you haven't bought the ticket yet and you still want to do it, I think it's still possible. So just tell me you're going. And of course, I hope I will see you tomorrow for the last day of the Bitcoin Summer, which is the DeFi on Bitcoin Day. It's going to be really interesting, lots of interesting guests. So thank you, and thank you for everything.